I'm Jim Dorn, Vice President for Monetary Studies at the Cato Institute. Welcome to Cato's 40th Annual Monetary Conference. Pleasure to have you with us today. Our first conference, The Search for Stable Money, was held in January 1983. That search continues as we face the highest inflation in 40 years. A short time ago, the Fed was worried about hitting its 2% inflation target. In 2020, the central bank implemented a new monetary framework, flexible average inflation targeting. The idea was to make up for shortfalls by temporarily allowing inflation to exceed 2% while averaging 2% in the longer run. Yet, no specific time frame was given. This flexibility increases uncertainty about the Fed's commitment to price stability. Until recently, the Fed's mantra in setting its policy rate was lower for longer, but forward guidance was often misguided. The Fed's macro models were unreliable and forecasting errors eroded confidence in monetary policymaking. The Fed initially saw inflation as transitory and was slow to increase its policy rate. However, the consensus has changed and the Fed has made it clear that rates will rise until inflation falls to a more normal level, even if the US faces a recession. Of course, the underlying problem with our current monetary regime is that too much is expected from policymakers. The limits of monetary policy are often forgotten. Moreover, there is no clear rule for guiding policy. Karl Brunner, who spoke at Cato's first monetary conference, pointed to the importance of rules in the conduct of monetary policy, given the complexity of the real economy and the knowledge problem. According to Brunner, quote, we suffer neither under total ignorance, nor do we enjoy full knowledge. A non-activist, that is rules-based regime, emerges under the circumstances as the safest strategy. It does not assure us that economic fluctuations will be avoided, but it will assure us that monetary policy does not impose additional uncertainties on the marketplace. With its large staff of economists and access to massive amounts of data, the Fed missed forecasting the 2008 financial crisis and missed warning signs of the current inflation. At a forum hosted by the ECB in June, Fed Chairman Jerome Powell stated, quote, "We now understand better how little we understand about inflation," close quote. I hope today's conference will help shed light on the causes of inflation and provide positive lessons for improving monetary policy. Before moving to the first, Carol J. Bowen Jr. and Duval Bowen Family Foundation for supporting today's event. I'd also like to thank Cato's excellent staff for helping with the conference, especially Nick Anthony and Kiana Graham, as well as David Tassi and Jonathan Fields. Finally, thanks to all our speakers and moderators for taking time from your busy schedules to join us. Now let's begin with Fed Chairman Jay Powell and Peter Gettler, President and CEO of the Cato Institute. Thank you.
Thanks, Jim. Good morning, everyone. As Jim said, I'm Peter Gettler. It's my honor and privilege to be president of the Cato Institute. Before proceeding, I want to offer my congratulations to you, Jim. Cato's been an important voice in the monetary realm for over 4 decades. And while there are lots of people who have contributed to this, no one has contributed more to this work than our colleague, Jim Dorn. He's played as large a role as anyone. Jim inaugurated our monetary conference, and under his leadership, it's become an annual institution. Jim's presided over each of these conferences, including today's, which, as he pointed out, is our 40th. Following these past 40 years of service to Cato and our mission, during which he also created and edited our Cato Journal, Jim will be retiring later this month and will assume the title of Senior Fellow Emeritus at the Institute. Jim, I just wanted to offer our heartfelt thanks for your many contributions as one of the longest tenured employees in Cato's history. And I offer you best wishes for a fruitful and enjoyable retirement. I know you'll continue to make your voice heard in the policy debates and in the policy world, but I also hope you reserve plenty of time to enjoy your wonderful family. And now let's turn to the 40th Annual Monetary Conference. It's my honor and pleasure to welcome Fed Chair Jerome Powell to the conference. Along with Alan Greenspan and Ben Bernanke, he's now the 3rd chair of the Federal Reserve Board of Governors to address the conference. Jerome Powell was first appointed as chair in 2018 and then reappointed this past spring. And he's no stranger to the Fed. Prior to his time as chair, he served as a member of the Board of Governors starting just over 10 years ago.
That is okay.
The one certainty that seems to come with the position of Fed chair is that one will invariably face a time of great challenge. Paul Volcker confronted our last and worst bout of inflation. Alan Greenspan saw the stock market crash a mere 2 months after his confirmation. And Ben Bernanke led the Federal Reserve amidst the financial crisis of 2007 and 2008. And Chairman Powell, as we all know, has served throughout the COVID-19 pandemic and its aftermath, a period in which we've seen inflation reach its highest level in 40 years. As we've sat in front of Zoom screens over the past 2.5 years, I'll just speak for myself. Many of us have watched as our hair has turned grayer, but few of us have as good an excuse for this as Chairman Powell. We're delighted to have him with us today to have a conversation about key policy issues, what he's learned, and the challenges now facing the Fed. Chairman Powell, it's good to see you today, sir. Welcome.
Thank you very much, Peter. And thank you to, go ahead.
I don't think it's a failure of imagination on my part, nor do I believe anyone will be surprised if the first topic we turn to is inflation. As Jim mentioned, it seems policymakers were given, including at the Fed, were initially given a bit of a head fake on inflation. We heard policymakers ascribing the increase in price inflation to the pandemic and related supply disruptions. And while this has undoubtedly contributed, there seems a much stronger consensus now that it's been in larger part policy driven. Can you discuss for us or give us some insight into how your thinking evolved on this topic over the last 1.5 years and how those conclusions may have evolved as well?
So Peter, thank you. And Jim, thank you. And congratulations to both of you and to Cato on 40 years of great monetary policy conferences. So I think a good entry point for that question, Peter, is to start by recalling that before the pandemic, unemployment was at a 50-year low, inflation was low and stable, and the economy was growing steadily, with no obvious imbalances threatening continued expansion. So, of course, in that sense, none of this high inflation that we see around the world now would have happened without the pandemic. The pandemic severely disrupted the economy, gave rise to risks of much more dire economic consequences than actually transpired really. And that was thanks in part to the policy response. So to start with policy, there's no question that policy certainly supported strong demand. But in my view, you would not have seen anything like the inflation that we have seen without the pandemic effects. And those pandemic effects include both shifts in demand and also playing a role in, not solely causing, but playing a role in the supply side constraints that emerged. So as for the pandemic, it did lead directly to an extraordinary shift in demand away from in-person services and to goods. And that shift, of course, was a major contributor to inflation in goods prices, which was really the main inflation story at the very beginning when inflation broke out suddenly in March of 2021. It's worth remembering that inflation actually declined in the early stage of the pandemic and then suddenly rose up in March of 21. The pandemic also contributed to the constrained supply in a number of important ways, including a large and persistent reduction in the size of the labor force, which contributed to extremely tight labor market conditions and upward pressure on wages. Also, the turmoil in global supply chains was probably caused to some extent by pandemic-related shutdowns, as well as strong demand, and particularly goods demand. I think cars are a good example. So yes, people had money and rates were low and demand for cars was strong, but also the pandemic shifted demand upward for cars because some people wanted to avoid public transportation. That amped up new demand for new and used cars. And also the shortage of semiconductors for cars emerged from pandemic-related demand shifts as well. So the bottom line for me is that there's really a role for both here, and the two are tangled up in a way that it's really not easy to disentangle.
Those of us who grew up in the 70s, I think that the danger and cost of inflation, can't be exaggerated. In September of 1979, his first testimony, a month after he was confirmed, Paul Volcker made clear he understood the damage that was being caused by inflation and the need to bring it down, even if it required great costs in other economic ways. One of the lessons of that episode was the greater the extent to which inflation slips the leash, the higher the cost and greater economic damage necessary to bring it under control. I worry whether we have the resolve to bring inflation under control today to face the potential economic costs. I took some comfort from your recent remarks in Jackson Hole, which seemed an attempt to signal that kind of resolve. But I do remain concerned that, the intense political pressure that might be brought to bear to avoid collateral economic damage before the inflation fight is won. And I just wondered if there's any way you can help me sleep a little bit better on that score.
Sure. So I think it's worth going back and remembering, and I pointed this out in my remarks 2 weeks ago at Jackson Hole, 10 days ago, that what Paul Volcker did and the Fed did to finally get inflation under control followed several failed attempts to get inflation under control. And what had happened over the course of that long period of the Great Inflation is that the public had really come to think of higher inflation as the norm and to expect it to continue. And that's what made it so hard to get inflation down in that case. So it is very much our view and my view that we need to act now forthrightly, strongly, as we have been doing, and we need to keep at it until the job is done to avoid that. We think we can avoid the kind of very high social costs that Paul Volcker and the Fed had to bring into play in order to get inflation back down and set us up then for a long period of price stability. That speech, the point really there was to deliver a speech that was narrowly focused on inflation, more direct and a lot shorter than a typical Jackson Hole speech. And I thought that what was appropriate was a very, kind of concise and focused message. To your question, the message really was that the Fed has and accepts responsibility for price stability, by which we mean 2% inflation over time. That, again, to your question, the longer inflation remains well above target, the greater the risk that the public does begin to see higher inflation as the norm. And that has the capacity to really raise the costs of getting inflation down. So finally, history cautions strongly against prematurely loosening policy. I can assure you that my colleagues and I are strongly committed to this project, and we will keep at it until the job is done. I can also assure you that we never take into consideration external political considerations. We are accountable to the public through Congress. That's a very fundamental, important aspect of our work. But we do not. We focus solely on the goals that Congress has given us, and that's what we're going to do here.
I think that that's really important because it's clear that we could see political pressure coming to avoid economic costs when there could be claims from political players that inflation is back in its box long before it is. Jim mentioned in his opening remarks that 2 years ago you moved to a new framework, flexible average inflation targeting, and I'm bringing this up now because, again, just reiterating the point about trying to sleep better at night. By many accounts, this move has created some more uncertainty in the market, as Jim mentioned. And coming at a time when inflation now has increased so markedly, it creates concern that despite your stated resolve, the commitment to price stability has become less strong. Should you consider modifications to this framework to assuage these concerns and better manage short-term expectations?
So the framework, we began the work on the new framework in 2018, and we announced the results in August of 2020. And it really followed 25 years, basically, of global disinflationary forces. And the problem was that monetary policy rates were close to the effective lower bound much too much of the time, much too close, and even during good times. So that meant that central banks were having a hard time all over the world, finding ways to support the economy when it was needed. And that's why central banks, including the Fed, resorted to things like forward guidance and asset purchases. So that's why we did that. But the changes that we made were sort of a very mainstream part of a literature around makeup strategies. But really the point of our framework changes, the point of all of them was to, and we said this very clearly, was to have inflation expectations well anchored at 2%. That the average inflation targeting idea was meant to support having inflation expectations. That is the goal at 2%. And the reason is that we believe that the public's expectations of future inflation will play an important role in the actual path of inflation. So that is kind of the fundamental basis of our framework. And as I just discussed, it is very important that inflation expectations remain anchored. I think the evidence today is that if you look at longer term expectations by households, businesses, and forecasters, and also markets, you'll see that they are pretty well anchored around 2%. Of course, short term expectations are higher because of high current inflation, and also the clock is ticking. As I mentioned, the longer that inflation remains well above target, the greater the concern that the public will start to just naturally incorporate higher inflation into its economic decision making. And our job is to make sure that doesn't happen. And we're committed to doing that job.
It seems to me there's a chance that there's a real risk that the labor market, that the labor shortages persist. Does that create a risk that takes some of the ability to manage this process out of your hands? To the extent that there continue to be labor shortages, does that then feed into expectations that the public has about inflation, as you mentioned very prominently?
Well, I think you're right that if it does turn out that we are in a world of a persistent labor shortage over time, that'll be a challenging world for companies, and it will certainly create upward pressure on wages and that sort of thing. Today, the labor market demand is very, very strong still in the labor market. We're still printing new payroll job numbers at a high level. Wages are running at elevated levels, and so we think by our policy interventions, what we hope to achieve is a period of growth below trend, which will cause the labor market to get back into better balance, and that will bring wages back down to levels that are more consistent with 2% inflation over time. That's what we're trying to achieve. The shock to labor supply that we got from the pandemic was large and unexpected, and unfortunately persistent. I will say that just in the very last labor market report that we got last Friday, we did see a welcome increase in labor force participation. Nonetheless, still a full percentage point below where it was before the crisis. And I think it's important as a society that we have measures in place to support a strong labor market and high labor force participation, and that goes beyond what we can accomplish with monetary policy.
You've made some contrast to how things are different today. What's different today from the high inflationary period of the late 70s and early 80s. I guess some other distinctions are, I remember as a student in Boston in the early 80s, in the days before the internet, I remember seeing people actually line up at the Fidelity office to see the monetary aggregates released on a weekly basis. And the way the money travels through the economy has changed dramatically since Milton Friedman first said that inflation's always and everywhere a monetary phenomenon. I'm just wondering, how do you respond when people look to the huge spike in government spending and say, I think you answered this in part in the first question, but that when you look at the huge spike in spending and say the Fed's printed all this money, so of course we have inflation.
So I graduated from college in 1975, which was close to peak monetarism, and there was quite a focus on monetary aggregates, and I recall it just as you do. So to go to this current situation, so as part of our response to the pandemic, we did resort to large asset purchases to address what were pretty severe disruptions in markets, and then also to support the economy, and our balance sheet expanded dramatically. But remember that our purchases of securities don't actually increase the quantity of government obligations held by the public. They really change the mix because we issue bank reserves to pay for those securities. So we're not changing, the quantity of obligations. That is not to say that money growth wasn't high. It was, of course, extraordinarily high in 2020, and then slowed down in 21, and now is quite sluggish. And I guess I would just say it this way: whatever caused, there are different theories on what caused the inflation that so suddenly jumped up out of the ground in March of 2021. whatever that cause was, the relationship between the money supply and inflation economic output has been much more unstable than it was in Friedman's day for a very long time. And so literally changes in monetary aggregates have not had a consistent, reliable relationship. They haven't been a good predictor of the economy or of inflation. Now, of course, the economy is ever changing, and that too could change, to where it is important again. But for now, and for really many years now, monetary aggregates don't play an important role in our formulation of policy, and we don't think they're generally a good way to think about policy or about inflation. It's more about demand and supply and things like that. So that's where we would be on that.
That actually calls to mind, at Cato, we do have a strong aversion to a fully discretionary fiat money system. And so we do like to socialize and promote alternative frameworks that could policy and a market direction that eliminates some of this discretion. Jim mentioned that a consistent theme over the years of this conference has been, potential monetary rules. And that kind of calls into question whether inflation and prices are really the best targets to use for monetary policy. Some folks have advocated for a rules-based system, such as targeting nominal GDP, is something we've heard a lot about in recent years. Partly because, as you say, monetary policy is not suited to address, well suited to address supply shocks. Could you share with us some of your thoughts of that type of approach and whether it's something that you would consider?
So more broadly on rules, of course, Taylor rules have become part of the fabric of economic analysis and particularly monetary policy analysis in ways that must be far greater than John Taylor could have hoped when he wrote his original article in 1993. So, but no central bank and the Fed has never explicitly tied our monetary policy decisions to any formula, including Taylor rules. But Taylor rules, nonetheless, are ubiquitous in all of the work that we do. You have to have a way and a model of explaining how monetary policy will react, and some kind of Taylor rule is now very much part of the way we think. In terms of nominal income targeting, and by the way, I know that Cato is one of the home courts for nominal income targeting, along with Mercatus and some others. And I know that this is a lot of well-known experts, many of them at your institution, do support nominal income targeting. And I'll just say that, we've looked at that, I've looked at that, and really come to the view that nominal income targeting is not the right way to go. And I'll try to explain why. By the way, I know that these arguments are well known to nominal income targeters and will be found to be unpersuasive. But nonetheless, I'll just give you my
and one thing I would interject is that we have debates internally as well. And I think for us, the concept really is more wanting to socialize a number of alternatives and try to move towards alternatives that do have more of a market basis and again remove discretion.
I think that's a very healthy process, and the whole debate over many years about rules and discretion is a fascinating and important one that is far from over. So it's really a mix of the two. I think but getting to nominal income targeting. We've got a dual mandate: maximum employment and price stability. And it comes down to, is nominal income targeting the best way to promote that? We don't think it is. I don't really think it is. And part of that just is that it would be, I think, very difficult to explain to the public the relationship of a nominal income target, nominal GDP target to those goals. It's a level of complexity that, even some economists and policymakers struggle with, let alone the general public. So it seems like it would be a reach to sort of put that, for us to have that be our fundamental framework. And a couple of examples that would be difficult. One in particular would be, what do you do with changes in trend growth? We have, highly uncertain estimates of levels of trend growth that we amend down through the years, and many years later, we may have a very different view. But it is broadly understood, I think, or thought that trend growth has declined considerably rather, over the course of since the global financial crisis. So how do you incorporate that into a nominal income target? Do you just raise the contribution of inflation, or do you annually re-estimate trend growth. And if you do that, you're incorporating both communications issues, but also, just big chances of policy error, because we just don't know these things with that kind of, we don't know any of the starred variables, so to speak, with that level of certainty. So I'll just say it's really interesting, and it works very well in models, but it seems difficult to implement from a practical standpoint, and it's not something that we have chosen to do, or that we are currently looking at.
You mentioned a dual mandate. I don't want to ignore the unemployment rate during this conversation. When I said earlier that, we obviously have an aversion to a, fully discretionary monetary system, many of us also regret the adoption of the dual mandate in lieu of a strict focus on monetary stability. The Fed's own website acknowledges that maximum employment is driven mainly by non-monetary factors. And if we accept that, does it really make sense for employment to be part of the Fed's mandate?
So, Peter, as you know, we're created by Congress in statute, and Congress assigns our goals, and it has assigned maximum employment and price stability. It's my view that the dual mandate has served the public well and is generally workable. In particular, at the moment, I don't see the two goals as in conflict at all, because without price stability, we will not be able to achieve the kind of strong labor market that we want for a sustained period that benefits all. So I don't see a case for moving to a single mandate, but that's really a question for Congress, and we will of course implement whatever mandate Congress gives us. To your point about maximum employment, it's true that, and we do say that and have for some time, that non-monetary factors are really what drives the level of maximum employment, which clearly changes through the business cycle and over time. But we can and do assess that, and we do it transparency. And Congress has said that should be a goal, a co-equal goal with price stability. So that's what we're implementing. And again, I don't think there's a strong case for changing that. I don't think it hampers us in our pursuit, and I think we can achieve both goals in the medium term.
You stole my follow-up, because you started out saying Congress sets the mandate, and so my follow-up was going to be, well, should the mandate, should they consider changing the mandate? And I think you've answered that. But I guess a natural follow-up might be then that if the dual mandate weren't enough, there's been talk of adding more elements to the Fed's objectives, including like racial equity that seem far from the Fed's ability to address. In addition, the Fed's remit has expanded from the banking system to the broader financial system, and its regulatory responsibilities were widely expanded in the wake of the financial crisis. How does continuing expanding the Fed's mandates not undermine focus on that fundamental responsibility of monetary stability, beyond things such as the employment element of the mandate?
So I think our current mandate is appropriate, and I would not want to see it narrowed or broadened, for that matter. We've got narrow and we've got well-defined goals that we're supposed to pursue. And what we've gotten with that is a precious grant of independence that lets us pursue those goals without direct political control. For monetary policy, that's maximum employment and price stability. And I think that dual mandate has served the public well. I really don't think it would not be a good idea to broaden it to goals that might be inconsistent with those two mandates, and that would be very difficult for us to achieve with our tools. More broadly than that, though, I think it's really important that we stick to our assigned tasks and resist the temptation to take on issues that are the province of elected representatives or of Congress. And if we do that, if we do stray from our core mandates, that will eventually undermine the case for our remaining independent. And I think Fed independence is an institutional arrangement that has served the public well, and I think that's pretty well documented and accepted.
I mentioned a couple of times, our concern about a fully discretionary system, and one of the biggest of those concerns is that in the face of large economic dislocations, we've been running what really amount to unprecedented experiments. I would cite the quadrupling of the Fed's balance sheet in the wake of the 2008 financial crisis, and then doubling it again during the pandemic. To your credit, it was right before the pandemic that you were beginning to move towards reducing the balance sheet. Could you shed some light for us on where you hope to take the balance sheet over time, and what's the way that you really try to get there? Do you see the Fed ever moving back to a scarce reserve framework like it had before the 2008 crisis?
Sure. So in the last cycle, after we ended our asset purchases, we froze the size of the balance sheet in 2014 and then allowed it to shrink passively relative to the size of the economy for about 3 years. So as the economy grew, the balance sheet didn't grow. Then in 2017, we began to allow maturing assets to run off, and that process went on until 2019. By the end of that period, we had a balance sheet that was significantly smaller relative to the size of the economy and smaller than it was overall. So then we resumed asset purchases, as you know, 2020, and once again now we are embarked on shrinking the balance sheet, and the test will be back to levels that satisfy the public's demand for our liabilities. That's currency and reserves and things like that, but also with reserves maintained at levels that are consistent with our ample reserves regime. So the balance sheet is substantially larger now, obviously, and consequently the runoff process is designed to be substantially faster than in the last cycle, to the tune of on the order of $1 trillion of runoff per year. That process began in June. Once it's up to full speed, the process began in June, and the pace of the balance sheet increases actually rises this month. The plans are spelled out in detail on our website around the January and May meetings. And of course, one thing we always say is that we're prepared to adjust the details of the plan based on economic and market developments at any time. As far as returning to a scarce reserve regime, I guess I would say that I think that our current operating framework is a better one, and I don't see a case for returning to scarce reserves. Now, why is that? So the world has really changed as a result of the global financial crisis and the pandemic. The scarce reserves framework would be challenged to work in a world where there's very high and sometimes volatile demand for safe and liquid assets. Central banks may need to rely on large-scale asset purchases again from time to time in response to severe shocks. And remember that the large financial institutions hold very, very large quantities of safe assets now as a liquidity buffer, and that includes a lot of reserves. So the bottom line is that the quantity of reserves is just so much higher. It would seem to be impractical to try to manage scarcity, and demand will be volatile too. So it doesn't seem practical. And again, we think that the current system works well and provides a lot of liquidity to the system, which is kind of a net gain.
All right, I thought it might be time to shift gears a little bit away from inflation and monetary policy. I remember the first year I joined Cato, I read an op-ed in the Wall Street Journal advocating for the Fed to implement a digital currency. And I was kind of horrified at the privacy implications of this prospect and said so in a letter to the editor at that time. Since then, the Fed has formally stepped into the digital currency ring, and digital currency has obviously been a very recurring theme in these conferences, but the Fed has stepped into this arena with a discussion paper on a central bank digital currency and several speeches from Fed governors. Our team has reviewed the more than 2,000 comments that the Fed's central bank digital currency discussion paper received, and we find that about 2/3 of them are concerned or outright opposed to the idea. Commenters raised concerns of financial privacy, financial oppression, and disintermediating the bank system, some of the same concerns that led me to write that letter to the editor 7 years ago. How can these serious concerns about privacy and freedom be reconciled with a digital currency?
Let me start by saying that we haven't made any decisions at all about whether to issue a CBDC, and we continue to evaluate the pros and cons and look at the technical questions and the policy questions, and we expect that evaluation process is going to take some time, appropriately so. Secondly, I'll say that we do not intend to proceed with issuance of a CBDC without clear support from both the executive branch and from Congress, ideally in the form of a specific authorizing law. So it was very gratifying, 2,000 and some comments. And, I won't tell you that I've read those, but I've read all of them, but I've read some of them and I've read the summaries. And, it's a lot of very thoughtful concerns, including the ones that you raised. And there are things that we're considering very seriously. So we in our own paper, we suggested that a CBDC, in our jurisdiction should be privacy protected, intermediated, widely transferable, and identity verified. So on privacy protection, let's start with that. Very, very important. And we all see what's happening with the digital RMB and the issues with privacy. We would not want a world in which the government sees in real time every money transfer that anyone makes with a CBDC. That would not be something that would be at all attractive in the American context. So privacy protection is going to be extremely important, and we're attentive to striking a balance, of course, between law enforcement and privacy protection. But that can be managed in the same way that it's currently managed in the banking system, or in some similar way. In terms of another issue, really is disintermediation, and that really is a question of, if, say, you had an interest-bearing CBDC, it could be attractive. It could compete with deposits, could draw deposits out of the banking system. That could limit credit availability. That's another issue to be managed. I think one of the things that actually that Cato mentioned in your was also the run risk issue, and that is the question of, are you creating an asset that would be very attractive in a panic or severe stress situation, and fostering runs. So look, it's going to be, as I mentioned, it's going to be, we think our role is this. We want to carefully and thoroughly analyze the public policy and technological challenges, public policy trade-offs and technological challenges. That's what we're doing. The idea is that this will lead all of us to a better understanding of those trade-offs and prepare the way for, hopefully, a well-informed decision on whether and when to issue a dollar central bank digital currency. That's what we think our role is, and we think that the Fed is the right institution to do that. We can proceed without, we're a nonpartisan institution, non-political institution that we can do these things, and I hope present conclusions and analysis that will support an intelligent decision when it's time to make that.
Well, this is something we'll definitely be having a lot to say on in the future, as well, particularly from a perspective of privacy concerns. That's being a watchdog on those issues is a very important role for Cato. I do want to ask about cryptocurrency, but first I should probably, in fairness, reveal that the gentleman who photobombed Janet Yellen 5 years ago by holding up a buy Bitcoin sign behind her during her Humphrey Hawkins testimony earlier this year became my son-in-law. So that's a little bit of a disclaimer I'm going to put out there. But without debating the merits or future of cryptocurrencies generally, or one or another crypto products, I'll say that in the monetary arena, Cato stands for nothing if not a desire to see more interest in monetary policy, to see more people concerned about our discretionary fiat system. And also, we want to see private market innovation and experimentation in developing alternatives, and crypto is just such a great example of this. There's a long history of government and regulation thwarting such innovation and experimentation, which we find really disappointing. So I wonder if you could respond to these kinds of concerns, namely that regulators might ultimately strangle crypto to the extent that it really does develop into a viable alternative system.
So I'll talk about it in two pieces. One is unbacked cryptocurrencies as such, and those have not and don't appear to offer, have not offered and don't appear to offer much in the way of public interest in using them as payments. Let's say it's not a great store of value. What it is a speculative asset. It's not backed by anything.
There could be an argument that that's still during the development phase, and that it's something that we could see emerge. But
yes,
be that as it may.
And I also have close-in family members who offer that perspective vigorously. So, as you suggest. But stable coins is a different thing, and the question is, are there forms of private money like stable coins which can play a role in our financial system, which would, and the answer is, of course, that we don't want to stand in the way of appropriate innovation, particularly including, digital innovation. But we think that something like that, which is, purporting to be money, would need to be appropriately regulated. And I hear that wide agreement on that, by the way, from a lot of the stablecoin companies now are seeing that as part of getting to a place where they are a legitimate part of the financial system. So I think you need regulation. If people are going to think something is money, then it needs to actually have the qualities of money. And if it doesn't, then you don't want. I don't think you want to take money and make it into just another consumer product where sometimes it fails and sometimes it's good. You want it to be guaranteed to be good. If the public's going to look at it like it was a dollar, you want to have clarity, transparency. You want to have full reserves of very liquid, high quality assets, and things like that. That's all. So I think that we need legislation on this. Just it's typical of technological innovations. There isn't a regulatory framework that really gets after payment stable coins. And so I think that's what's needed. But I wouldn't think of us as being opposed to that kind of innovation. We're more the people who are saying, among others, that we need appropriate regulation.
Yeah, and the devil's ultimately in the details. I mean, while we have these debates, I mean, we would concede, we're living in a world where we will see innovation, and we've basically promoted, a light touch, market focused approach, because there is a real risk of again, having an impact on the development of these innovations and really thwarting what could be very promising and useful innovation.
No, and I agree with that. We don't want to be in that place. We want to be in favor of innovation, but also of appropriate regulation.
Mm-hmm. And ultimately, some of the people who end up driving, the regulation might be, as you mentioned, legislation. The end product may not meet the objectives that you and I both say that we want. Another topic, as long as I can remember, successive chairmen have warned of our unsustainable fiscal path. Regrettably, no one in Congress or the White House seems to be listening. I'm, particularly during a period of high inflation, I've been, continually chagrined at, the number of big spending bills that continue to come down the pike and legislation that's passed. Long after I think the crisis of the pandemic has ended. The lessons of the financial crisis and COVID might be that keeping our fiscal house in order is essential as preparation to meet the challenges of unexpected but inevitable economic dislocations. But the opposite lesson seems to have been learned, that we can keep spending whatever we wish without worrying about a day of reckoning. And I just, I'm very concerned about the day of reckoning and what risks we're laying for the economic well-being of future generations. And I just wonder, your thoughts on those concerns and the potential timing of that day's arrival and its consequences, and whether you have any ideas about how we can build a real constituency for fiscal responsibility in America.
So I do share those concerns. And in fact, I was working on those issues before I joined the Fed. But at the Fed, my position needs to be that fiscal policy really is the responsibility of Congress and the administration. Wouldn't be appropriate for me to comment too much on specific policy proposals or laws. More to the point, with inflation running so far above 2%, this is probably an especially good time to focus on achieving our own mandate rather than doling out advice to others. But like my predecessors, I'll point out that our federal fiscal policy is not on a sustainable path, and it really hasn't been for some time. And we will need to get back to a sustainable path sooner or later. To your point, sooner is better than later. And I guess I'll just leave it at that.
All right, thanks. We're getting close to the end of our time, so I'm thinking about a closing question. I wonder, with everything that we've discussed thus far, what are some of the key lessons that you've learned since you became Fed chair, and what advice might you give to a lot of the young, monetary scholars out there that Cato and other places are working to develop?
So I guess I would say that both experience and also studying history are great teachers of what can be hard lessons. And I actually mentioned 3 lessons at Jackson Hole 10 days ago, and those were first that the Fed does have and accept responsibility for price stability. Even now, some are questioning that, but that to us is settled. Secondly, that inflation expectations are really important and need to be carefully monitored, because if they do move up, they can make the job of getting back to price stability so much harder. And third is that, the record is there is a record of failed attempts to get inflation under control, which only raises the ultimate cost to society of getting under control. Hence the need to do this job now and keep at it. So those are three lessons. I would say more broadly, another really fundamental lesson is, to me, is that the structure of the economy is ever changing and highly complex. And we see that today around the world. Many nations are experiencing the first high inflation in 40 years, all around the world. Different countries have different composition and backstories, but it's really quite global. And the question really is this going to be a temporary thing that's really related to the pandemic in some way, or is there actually something more structural and persistent happening? For example, if we're moving to a world where we're going to see more frequent, larger, and more persistent supply shocks for whatever reason, that will have critical and difficult implications for the conduct of economic policy and monetary policy in particular. So this is not possible to know right now, but it's certainly a question that looms. I mean, to sum it up, I would just say economics is not physics. There isn't any specific temperature at which the economy boils over. It does boil over from time to time. And when that happens, it often takes many years of analysis, discussion, and debate to reach general agreement on why that has happened. So the point is that we are always making monetary policy under high uncertainty about the structure of the economy and the path ahead. That makes our work challenging. It also makes getting it right very important for the people that we serve. And we do think about that every day. So our understanding of the economy has to evolve. As the economy evolves, as time passes, we do learn more. And I think it's okay to follow the evidence and change one's mind. I think advice to scholars young and old is that people shouldn't be afraid to say that they've changed their view and explain why. I actually find that refreshing when people say, my view has evolved in the face of the evidence. I guess one more word to close for those young researchers you mentioned, and this is a commercial for public service and for the Fed. So the Fed is a very special place where people can combine policy research with policy making. This is a place that all of us have a very strong sense of mission in our work, which is very satisfying. And that mission is to serve the public. And it really matters. Our work really matters to the public. I would say there's no higher calling or more satisfying mission. So I hope that young researchers and economists and others will consider public service as part of their career. For me, it's been only a part. But in particular, consider working at the Fed, where you'd be most welcome.
Thanks for that. I mean, I share those sentiments. As you mentioned your work at the Bipartisan Research Center, and I'm at Cato because I care about the future of our country and the future, of course, of liberty and freedom in America, and for the kind of world future generations are going to grow up, and whether they're going to have the same opportunities that we all have had to live in a free country and to pursue their American dream, and being part of that is a real privilege. I know, at Cato, we work very hard to raise consciousness of monetary policy and the potential for monetary reform. We wish that, we think this is a very important topic, and that more Americans should pay attention to it, even though it's complicated. We wish there were more policy organizations that would prioritize this policy area and raise their level of resources dedicated to this area. And as you know, Mr. Chairman, Cato is not shy about being critical, and we enjoy intellectually jousting with you and your team. But we also recognize that we share common goals and objectives for our country, and it's in the country's best interests, by which that jousting and those debates and areas of disagreement. It's within that context that they occur. And so I do thank you for your work. You're in a challenging position, and I thank you very much for being part of this conference today. It's been a real pleasure.
Thanks, Peter. The pleasure is mine too.
Thanks so much. And with that, I'm just going to let all the viewers know that we're going to be taking a break now until the top of the hour. So we're going to reconvene with the next panel at 10 a.m. So we'll see you then. Chairman Powell, thanks very much again. Have a great day.
My pleasure. You too.
Right. Well, welcome back, everybody. I am Nick Timmerhouse. I'm the Chief Economics Correspondent for the Wall Street Journal. I'm going to be moderating our next panel. And so thank you for joining us today. I am joined by Mervyn King, who is the former governor of the Bank of England, Claudia Borio, who is the head of the Monetary and Economic Department at the Bank for International Settlements, Larry Summers, the former Treasury Secretary and the professor at Harvard University, and Tyler Goodspeed, who is a Klein-Heinz Fellow at the Hoover Institution and served at the CEA in the Trump administration. Our panel today is on what have we learned, and you can submit questions for the audience that we will get to later on Cato's webpage. You can submit those on Facebook. You can submit them on Twitter using the hashtag CatoMonCon. And we will get to those questions after presentations from all of our panelists, which we will get to right now. And we will start with Mervyn King. So Lord King, over to you.
Thank you, Nick. Well, I'm delighted to join you all at this Cato Institute's 40th annual monetary conference. 40 years ago, we were coming out of the Great Inflation, when inflation reached double digits or higher. The lessons learned then were clear. Macroeconomic policy should aim at price stability and a sustainable fiscal position. Microeconomic measures, such as tax and labor market reform, should aim at improving the supply side. Over the next 10 years or so after that, monetary policy was given the explicit task of achieving price stability, and eventually all major central banks adopted, in one form or another, flexible inflation targeting. Since then, CPI inflation has averaged close to the 2% target until recently. Inflation in the industrialized world has now risen to close to or around 10%. So what has gone wrong? What have we learned? And just as important, what have we forgotten? I want to suggest that there are three key lessons from the past 40 years. First, inflation targeting is not a new theory of inflation, but it's a way of helping central banks to make decisions about monetary policy. Second, money matters. You can't explain inflation solely in terms of real variables, despite the attempts of very clever economists to do so. And third, the misuse of models has led to hubris about the ability of monetary policy to fine-tune inflation. So let me take these in turn. First, the origins of inflation targets lay in a desire to improve the way policy decisions were taken and to enhance the transparency and accountability of those making decisions on interest rates. Inflation targeting was really a compromise between rules and discretion. It was constrained discretion. What inflation targeting was not was a theory of the monetary transmission mechanism or how inflation gets determined. It was much closer to a way of healthy living for central banks. And like any successful diet, it steers away from boom and bust and is a continuous process. Unfortunately, as inflation targeting spread around the world and appeared successful, the academic profession turned a way of life into a rather precise, indeed hubristic view that central banks can control closely inflation. And I think this led to mistakes in 2020 and 21. Instead of asking what's going on here in the economy, the pandemic was seen by all central banks as a particularly large business cycle downturn. And I think this was a misdiagnosis of a situation in which supply certainly fell sharply following government and business decisions to curtail output, but demand also fell in tandem with the fall in short-run potential output. So the fall in both demand and supply didn't open up a significant output gap. And from that perspective, there was no real need for a large monetary policy stimulus. There was a need for governments to use fiscal policy to prevent the lockdown and shutdown from creating high unemployment for a long period when the impact of the pandemic was expected to be short-lived. In Europe, we achieved this through furlough schemes, and in the US by temporary but quite generous support to the unemployed. And there was a need for central banks to intervene in March 2020 to deal with dislocation of some financial markets by acting as a market maker of last resort. We did this in the corporate bond market and others during the financial crisis. But once the dislocations disappear, as they did, the support should be withdrawn. By engaging in substantial amounts of quantitative easing, QE, in both 2020 and 2021, central banks injected large amounts of money into the economy. In the US, broad money rose at the fastest rate since the Second World War. Now, that rise in money was compounded by a lot of bad luck. Following the Russian invasion of Ukraine and its impact on global food and energy prices, the rise in core inflation was augmented by a rise in what we hoped would be a temporary rise in global food and energy prices. And in the US, obviously, the monetary stimulus exacerbated the problem created by the excessive fiscal stimulus, as argued by Larry Summers. But don't forget or overlook the role of the expansion of QE. Of course, the good news here is that the mistakes, which I believe were made in 2020 and 21 in monetary policy, ended then and there. We're no longer injecting lots of money into the economy. The Fed's now fully committed to bringing inflation back to target, painful though that may now well be. And Chairman Powell emphasized that in his remarks a few minutes ago. That's the first lesson. Inflation targeting is not and shouldn't be seen as a theory of inflation. The second is that money matters. It's slightly bizarre for a central bank to stop thinking in terms of money when inflation is by definition a nominal phenomenon. You can't explain inflation in a model with only real variables. But central banks have been seduced by the idea that inflation can be explained solely by expectations, which in turn are determined by the inflation target. I think this is hubris. It's a failure of common sense. Why should expectations be anchored to the target when inflation is rising rapidly and central banks argue that the rise in inflation is purely transitory and appear complacent in terms of their response? When I was at the Bank of England, the staff would prepare forecasts of inflation for different paths of interest rates. No matter what path was chosen, inflation always came back to 2% in the medium term. Why? Because the model said it had to return to the target. I did not find this reassuring. In 2020 and 2021, the acceleration of broad money growth in the US to its highest level, as I said, since the Second World War, should have been a warning sign. I worry that intellectual hubris among the economics profession has led to the abandonment of the old and rather common sense view that inflation reflects too much money chasing too few goods. In the pandemic, the response of governments and businesses ensured that there were too few goods, and central banks ensured that there was too much money. The result, higher core inflation, was both predictable and predicted. Now, I think that the unfortunate obsession of the earlier US monetarist community with a monetary base has in part been responsible for the belief that inflation can be explained solely in terms of real variables with the quick addition of an inflation target. An analysis of monetary developments, especially broad money, should be part of a narrative which central banks convey to explain their actions. And I think central banks should be much clearer that QE is money printing. The third lesson, I think, of the last 40 years is that the misuse of models has led to hubris about the ability of monetary policy to fine-tune inflation. Models are most useful when they are seen as parables. They provide useful insights, but they're not descriptions of the world. The world is far too complex and uncertain to be captured by any model. And unfortunately, the attempt to build precise quantitative models of inflation targets led, I think, to hubris about our ability to predict and control inflation. Over the past decade, the intellectual consensus became one of thinking that the biggest challenge to monetary theory was to explain why central banks were finding it difficult to raise inflation up to the 2% target. I found this a bizarre view. Over the decade that followed the financial crisis, annual core PCE inflation in the US never threatened to go below zero and averaged around 1.5%. Now that's true, that's below the target of 2%. But from the perspective of the 1990s, when inflation targets and independent central banks were gathering speed, this would have seemed like nirvana. And the search for new policy tools to fine-tune inflation reflected, I think, this academic hubris. It gave birth to forward guidance, to yield curve control, to asymmetric flexible average inflation targeting, and excessive focus on point forecasts. I hope that these developments can now be consigned to footnotes in monetary history. Now, finally, the intellectual failures that I've stressed are not and should not be seen as the responsibility of either central banks or individuals inside those institutions. In my view, they rest fairly and squarely on the attempt by the economics profession to set monetary policy in their model and not in the world. The immediate challenge is that having allowed core inflation to rise, and with an exceptionally tight labor market, it's probably necessary now to restore central bank credibility by bringing inflation down, even if that means a recession. And the inflation rate over the next 2 years is highly uncertain because the invasion of Ukraine could lead to further rises in food and energy prices, or they're staying at current levels, or indeed in some eventualities, they could fall back to pre-invasion levels. And the implications of this range of possibilities means that the range for future CPI inflation spans a range between double-digit levels and zero. So I do not envy my successors in handling this challenge, but I would urge them to bear in mind the 3 lessons that I've identified today from the experience of the past 40 years. Thank you.
Thank you very much, Dr. King. And now we will go to Claudio Borio from the BIS. Claudio, the floor is yours.
Well, thank you. Thank you very much, Nick. And it's clearly a pleasure to be back, although only virtually, and to be on such a distinguished panel. Now, this event is about the state of monetary policy after 40 years, roughly since the series of this conference began. So I thought that, well, Mervyn talked about 3 lessons. I will talk about 3 challenges from the past, the present, and the future, and try to explore the relationship between them. My key point is that the way that monetary policy tackles one challenge by interacting with the economic environment tends to define what the next one is going to be. And at the core of my presentation is going to be the evolving nature of the business cycle, the role that financial forces play there. So where does the story begin? And in fact, it does begin some 40 years ago in the early to mid 1980s, when I think a subtle change in the nature of the business cycle took place from what I would call inflation-induced to financial cycle-induced recessions. And by financial cycle, I simply mean the interaction between credit, risk-taking, and asset prices, especially real estate prices, that tends to generate expansions and contractions in those financial variables, effectively endogenous cycles, so that the expansion sets the basis, sows the seeds of the subsequent contraction. So what do I mean exactly by this shift? Well, until the early to mid 1980s, the typical recession was triggered by a rise in inflation, therefore a tightening of monetary policy, with rather little happening to variables such as that are indicators of the financial cycle. Thereafter, well, we know that inflation was low and stable. Therefore, there was little reason for central banks to tighten. But then a big financial expansion turned into a contraction. And the great financial crisis is just the most spectacular, just one, and the most spectacular example of that process. And we've done some research that shows that this is a more general phenomenon. So you may ask, why did this change take place? Personally, I think that it has to do with some fundamental changes in policy regimes, and I would identify three policy regimes across the world. The first was a shift from financially repressed to liberalized financial systems, which simply provide a greater scope for these financial expansions and contractions to take place. The second was the globalization of the real economy, which provided some powerful tailwinds that increased the production possibilities of the world economy, and in particular put persistent disinflationary pressures of a structural nature. And last but not least, the establishment of credible monetary policy regimes that were very much focused on near-term inflation control and paid little attention to credit and monetary aggregates, to go back to a point that Merlin made just a few moments ago. Now, I don't think that it is a coincidence that the nature of the business cycle that we saw over this long phase came to resemble much more closely those that we had seen from 1870s to the Great Depression, if you like, the gold standard period, which was identified as the first globalization era, financial and real, and coincided with relative price stability in the world. So put differently, and this is the key point, inflation became an unreliable signal of the sustainability of economic expansions, and hence, by the same token, a less reliable compass for monetary policy. Implications of this, a couple for policy and one for the economic environment more generally. One about policy, the first one is that, of course, monetary policy did tighten relatively little during expansions, but then eased strongly and persistently during contractions in order to deal with the very strong financial headwinds that it was tackling. And this resulted, or at least contributed to, a progressive loss in the room for policy maneuver. And then the unreliability of inflation, and this is the second point, the unreliability of inflation as a signal of the sustainability of economic expansions was actually transmitted to the lack of reliability, unreliability of the so-called natural interest rate of R star as a guide for policy, because we know that R star is defined largely in terms of what happens to inflation when output is the same as equates potential. The implication for the economic environment is that this asymmetric response, together with broader changes that we saw in the real economy, tended to contribute to a progressive increase in debt levels relative to GDP to historically high peaks, both, I'm talking about both private and public sector debt. And here you see a certain element of a debt trap, because low interest rates and high debt tend to reinforce each other, so that it becomes harder to raise interest rates without creating problems for the economy. And this is very much a rather burdensome legacy. Which takes me to the present. I think we're facing an unprecedented set of economic circumstances, and that is a risk of recession driven by an increase in inflation and the need for monetary policy to tighten, what we saw until the mid-1980s, with widespread financial vulnerabilities, in particular high levels of debt, which was, if you like, the key feature of the period after the early to mid-1980s. Now, this clearly greatly complicates the calibration of monetary policy. We know that the economy is going to be more sensitive to interest rates, but we don't know how much. And let me remind you that real interest rates are firmly in negative territory in much of the world. And of course, there could be implications for financial stability that maybe we could address in the Q&A. Now, of course, against this unique background, the natural question is, why did inflation that had been so dormant for so long surge again? Now, this is a difficult question. Everyone has an answer. In the annual economic report that came out in late June, we thought that probably the most, I would say, the best explanation, at least the one that we could come up with, involves three factors. And in all of this, of course, the COVID crisis has an important role to play. Now, the first one is a surprisingly rebound in aggregate demand. This was partly simply because it was a spontaneous rebound after demand had been repressed artificially for so long. But it was also, and this is important, it was also fueled by macroeconomic policies. I'm not just talking about fiscal policy, but also by accommodating monetary policy. The second factor is a surprisingly persistent rotation of aggregate demand from services to goods, which put global supply chains under a lot of pressure. And finally, inelastic supply, which was unable to keep up with this big surge and rotation in aggregate demand. Now, I tend to think of this as, if you like, the rumblings or ructions of an engine. Think of it as the global economy, which you switch on after having switched off for some time, but not only switched off, to which you have added high octane fuel and also kicked quite hard. Now, of course, more recently, the war-induced negative supply side shock has further added a lot, substantially, to the inflation pressures. And I'm thinking in particular of the increase in commodity prices, energy and food, especially. Now, regardless of the specific causes of the surge of inflation, and let me stress, regardless of what those causes are, I think it's essential for monetary policy to react, and it has reacted, and of course, to get the job done. Now, the key reason for this, which I would like to stress, is that transitions from low to high inflation regimes tend to be self-reinforcing. Now, in the annual economic report, we develop a complementary view of inflation, which basically sees it as two regimes, high and low inflation, which are actually very different in terms of the price dynamics, with self-reinforcing transitions from low to high. Now, why self-reinforcing? Well, a couple of reasons. First of all, because when inflation starts increasing, it moves from the region of rational inattention, in which it has hardly any impact on agents' behavior, into the region of sharp focus. And second, and closely related to that, is that it becomes more representative of the prices that agents care about. And this is because inflation, those changes in prices become more similar, they become more synchronized. So that as a result of all this, inflation can become a better coordinating mechanism for the behavior of economic agents, and therefore also help trigger wage and price spirals. Now, of course, as was mentioned before, and as was mentioned by Chairman Powell, the near-term costs, there will be near-term costs of bringing inflation down, but those near-term costs are much smaller than the costs that would have to be incurred if inflation became entrenched. So you have an important intertemporal component that one should bear in mind. Now, all this raises a number of lessons, and let me just mention one of them, which was highlighted by Agustin Carstens, the general manager of the BIS at Jackson Hole just recently. And that is that the low inflation regime that prevailed for so long may have masked the supply constraints, the inevitable supply constraints that were there. But those constraints obviously had not gone away. Now, until recently, they took the form of financial instability, these huge financial expansions that had to come to an end. More recently, they have taken the more familiar, but probably almost forgotten form of higher inflation. So the key point here is that it is always dangerous to have macroeconomic policies, fiscal and monetary policy, trying to test those limits, because that which is an inevitable implication of those policies, cannot be the engine of long-term growth. Which takes me to the future. What is going to be the likely future evolution of the business cycle? I think that there are reasons to believe that the environment is going to become structurally more inflationary. Now, personally, I have always felt that the end game of the trajectory the global economy had been following for over 40 years would have been inflation. But probably what happened is that the two exogenous shocks, the pandemic and the war, have brought forward what could have been the endogenous end game that I was referring to. So why structurally more inflationary? Well, a number of reasons. First of all, the macroeconomic favorable tailwinds that we saw for so long are turning into headwinds. One example is demographics. We know that that's going to turn, but the one that I have been stressing is globalization. And of course, we are seeing signs that globalization may be in retreat. In addition, looking forward, one can also see new headwinds emerging. And the one in particular that I have in mind is the greening of the economy. Furthermore, in the background, the geopolitical and political environment is becoming more hostile to international cooperation, and also more hostile, I would say, to the role of market forces in the economy. And we see that populism is on the rise. And last but not least, going back to what I said earlier, we still have with us the legacy of those 40 years, which is much higher levels of both private and in particular also public debt. So it's not hard to see how this environment, which is closer to what we saw actually in the 1970s, can be structurally more inflationary. Now, of course, the future is not preordained and is clouded in a lot of uncertainty. But I think that one thing is clear, and that is that this environment will test central banks to the full. It will test them from an intellectual perspective, the analytical frameworks that they use when setting policy, but also from a political economy or institutional perspective, because it is very likely that central bank independence will come under greater threat. There are a number of reasons, but just think of the fact that interest rates will be rising, and that will make the costs of the current historically high levels of debt much more visible. So far, of course, central banks have shown their mettle, and they have pivoted very forcefully in order to get inflation under control. But if what I said is probably right, and we don't know whether it is, I think that tougher tests lie ahead. So thank you very much.
Thank you, Claudio. I'll take a quick minute here just to remind everybody you can submit questions that I will pose to the panelists in a little bit via Cato's webpage, Facebook, YouTube, or on Twitter using the hashtag CatoMonCon. Next will be Larry Summers. Now, Larry couldn't make it live today, but we were able to record a video presentation with him ahead of time. And I'm not sure if we have audio for Larry. We'll take just a second there.
It is most unusual, Nick, to be able to see Larry but not hear him.
Yeah, there's a first, right? I think the team here in DC is going to try to get the audio to work in the interim here. If we're not able to get Larry's comments now, then we'll jump to Tyler and we'll come back to him. We'll just take a second here and see if they're able to get a audio version of Larry to work. And again, go ahead and submit your questions. There's some good ones that have already come in, and we'll get to those as soon as the opening statements presentations are concluded. I'm going to go ahead and call on you, Tyler, and we'll try to get back to Larry after your comments, Tyler.
Okay, thank you, Nick. And I was going to say one of the risks of speaking last on a panel of 4 is that by the time it's your go, you've run out of both time and the opportunity to say something novel. So to inoculate against that risk, I had actually decided to share the findings from a new working paper of mine, which has neither been posted nor presented yet. So the results have never been seen before this morning. So I'm going to go ahead and share my screen. So hopefully that works. And people should be able to see now. Title page, Trust the Experts.
Yes.
So a little over a year ago, just as survey measures of consumer inflation expectations began to rise while bond markets continued to shrug off the risk of a potentially persistent inflationary shock, I began to ask the question, who does a better job forecasting inflation, consumers or professional economists? And what does that mean for monetary policy? Now, what we see here are the 2 oldest continuous surveys of inflation expectations in the United States, the University of Michigan Survey of Consumers and the Livingston Survey of Professional Economists. The Michigan Survey has been asking a sample of consumers their expectations for inflation over the next 12 months since 1960, while the late financial journalist Joseph Livingston began conducting a twice annual survey of professional economists' inflation expectations back in 1946. And that survey since 1990 has been continued by the Federal Reserve Bank of Philadelphia. Now, these surveys have had a lot of changes over time. So it actually took a great deal of work just to ensure parallel construction such that we can have a genuine apples to apples comparison over time. But what that comparison shows is that while the professionals in the Livingston survey have been more accurate in recent decades, consumer inflation expectations tracked inflation much more closely during the great inflation of the 1960s, 70s, and early 80s. Now, we can test this more formally by regressing forecast errors on a constant and a binary variable indicating which survey we're looking at to see whether forecasts are systematically biased, i.e., are they on average different from 0 over time? And what I find is that whereas over the entire sample period from 1960 through 2022, I can reject the null hypothesis that consumers are unbiased. So on average, consumers overestimate inflation by about 0.5 percentage points. I cannot reject the null hypothesis that professionals are unbiased. So the experts are generally unbiased and their error is no different from 0. And on average, if I restrict the sample just to that early period of price stability before the great inflation, you can see the results are almost identical. But once we get into the great inflation from 1966 to 1980, I find that the experts on average underestimated actual inflation by a statistically significant 2.15 percentage points, while I cannot reject the null hypothesis that consumers' average forecast error was equal to 0. Both consumers and the professionals systematically overestimated inflation during the Volcker disinflation of the 1980s, though consumers performed on average slightly better, whereas during the period of the Great Moderation from 1987 until 2020, the experts' error was statistically no different from 0, whereas consumers systematically overestimated inflation. And since 2020, the average error of the experts has been more than double that of consumers. Now, digging deeper, when I look at forecast errors by inflation level, I find actually a statistically significant structural break at an inflation rate of 3.5%, roughly 3.5%. So whereas the experts exhibit smaller forecast errors across all inflation buckets below 3.5%, consumers exhibit much smaller forecast errors across all but one inflation bucket over 3.5%. And I see this as well when I formally estimate forecast errors above and below that 3.5% threshold. So when inflation is below 3.5%, relative to the experts, consumers overestimate inflation by a factor of 4. But when inflation is over 3.5%, I cannot reject the null hypothesis that the consumer's average error is equal to 0, whereas the experts systematically underestimate inflation by about 1.4 percentage points. What about other measures of forecast rationality? Well, one measure is that forecast errors should be uncorrelated over non-overlapping forecast horizons. On this measure, both consumers and the experts fail when inflation is below 3.5%, but consumers pass with flying colors when inflation is above 3.5%. Is there information in the forecast themselves that can be used to predict forecast errors? That would violate the assumption that all information is fully exploited. Again, both fail this test when inflation is below 3.5%, but consumers pass when inflation is above 3.5%. Another measure is that actual inflation should, on average, move 1-for-1 with the forecast. This is the classic Mincer and Zarnowitz test of forecast rationality. Here again, both consumers and experts fail when inflation is below 3.5%, but consumers pass when inflation is above 3.5%. And then finally, an additional measure of forecast efficiency is whether public information available at the time of the forecast is fully exploited. So here I estimate the effect on forecast residuals of the inflation rate, the T-bill rate, and the unemployment rate observed in the months immediately prior to the forecast. And once again, both consumers and experts fail when inflation is below 3.5%, but consumers pass when inflation is above 3.5%. Okay, so that suggests that while the experts do a better job than consumers when below a certain threshold, it's the consumers who do a better job when inflation is above a certain threshold. But what about specific moments of inflation regime change? So here I define an inflationary or disinflationary shock as a point in time at which the 5-year forward average inflation rate is at least 2 standard deviations above or below its trailing 5-year average. So this allows us to both identify a persistent inflation regime change, as well as the timing of that regime shift. What do I find? Well, here again, outside of periods of inflation regime change, I cannot reject the null hypothesis that the experts in the Livingston survey are unbiased. But consumers typically overestimate future inflation. But during these periods of inflation regime change, while the experts systematically underestimate future inflation, the consumer's average forecast error is statistically no different from 0. Both groups systematically overestimate inflation during periods of disinflationary shock by about the same magnitude, but that actually implies that the consumers have revised their expectations by more than the experts during those shocks. While neither group exhibits perfect rationality either during or outside of inflation regime change, the experts, for the most part, pass standard tests of forecast rationality during periods of low and stable inflation, while failing every test during periods of regime change. In contrast, while consumers fail every test of forecast rationality when inflation is low and stable, they pass several key tests of forecast rationality during periods of regime change, both from low and stable to high inflation and from high inflation to disinflation. So this speaks to that question of rational irrationality. What about the experts? Well, if we look at average forecast errors, professional economists affiliated with labor organizations, i.e. unions, generally perform the best in forecasting inflation. When inflation is low and stable, I cannot reject the null hypothesis that their average error is 0. While the professional economists with the biggest average forecast errors during periods of low and stable inflation are those affiliated with government. They consistently underestimate inflation by a statistically significant margin. During the transition from low and stable to high inflation, the worst experts are those affiliated with the Federal Reserve, who exhibit the highest average forecast errors. In contrast, the smallest forecast errors are once again those experts affiliated with labor organizations. The exact opposite is true during disinflationary shocks. Then it's the professional economists affiliated with the Federal Reserve who exhibit the smallest average forecast errors, while it's those with labor organizations that exhibit the largest. Looking at these standard measures of forecast rationality and efficiency, most experts do a pretty good job when inflation is low and stable, but with the exception of those affiliated with labor organizations, they fail miserably during periods of transition to an inflationary regime. So what does this all mean? Well, for one thing, I think this illustrates the importance of skin in the game. Is it purely accidental that the categories of experts who generally have the best track record in rationally forecasting inflation are those in the business of negotiating wage contracts and extending long-term loans, so labor organizations and commercial banks? Is it accidental that the average consumer facing a budget constraint pays closer attention to inflation when the cost of an average consumption bundle is impinging more on that constraint? Second, I would wager that the experts with access to the most sophisticated macroeconomic modeling capabilities are those with academic institutions, government, and the Federal Reserve. And yet it's precisely those experts who perform the worst on most standard measures of forecast rationality, particularly during periods of inflation regime change. And I think that ought to caution us against over-reliance on models when a lot of the relevant variables and underlying parameters are non-stationary. Finally, I think the most important lesson is that this affirms the merit of the old Greenspan definition of price stability as a level of inflation low enough that agents do not need to think about it in their daily decision-making. Because the evidence here indicates that once consumers do notice inflation, they're forced to abandon rational irrationality and instead pay exceptionally close attention to prices. And so while I'm open to the arguments, I'm wary of recent public suggestions that the Fed's inflation target should perhaps be raised from 2% to 3%, because the latter level would seem to be flirting dangerously with the level or threshold above which this research would suggest that consumers start to pay exceptionally close attention. Thank you.
Thanks so much, Tyler. All right, we're going to see if it's possible to keep Larry Summers silenced, and we will return to the video presentation that he recorded for us, and I think the audio should be working now, so stand by for Larry Summers. And maybe not, maybe Larry's still muted. We'll hang on just a second here to see if we can get that resolved. And while they work on that, I'll remind everybody again, you can submit questions online on Cato's webpage, on Facebook, YouTube, Twitter, using the hashtag CatoMonCon. We'll get to questions here if we're not able to resolve the audio for Dr. Summers' presentation. I'm going to go ahead and I'll jump in with the first question. There's an issue of inertia in central banking. And so I'll pose this question to the three panelists who are here, and I'll start with you, Mervyn King. We saw a lot of inertia, of course. There was the fast response to the shock in March 2020. And then once central banks were engaged in these asset purchase programs, there was a real fear of being pinned back at the lower bound, of having a long, difficult recovery like the one that followed the GFC. And so that created, I think, a sense of inertia that, well, this worked well in March, April of 2020. So let's stick with it. We don't want to make the mistakes that people thought had been made in 2008, 9, and 10. And I wonder now if you have a similar concern that once central banks are moving to raising rates in larger increments, the Fed has done 275 basis point increases. The ECB just did their first this morning. How do you think about the risk that once you start to move rates up at a higher rate of speed, you end up doing too much or going too far? Is that at all a concern here, that this kind of inertia in central banking, committee dynamics, et cetera, can make it harder to change course when it's appropriate to do that?
I think the worst mistake would be to believe that gradualism in raising rates is the right answer, namely that you just do 25 basis points or even in current circumstances 50, and just keep doing that for a large number of meetings. I think it's much more important to ask the question, what's going on? What's the right response? I think the problems that we've seen have been that ever since the financial crisis, most central banks were deeply reluctant to acknowledge that QE was essentially printing money, expanding the balance sheet, and instead tried to think about it in all kinds of complicated, sophisticated ways, credit easing, etc., which meant they didn't really confront the question of, do you really want to boost the money supply by only 5% or 25% or some other number? In 2009-10, QE offset what would otherwise have been a sharp decline in the money supply, which would have led quite possibly to another depression. And so that was, I think, the argument for doing it then, and it worked. The argument for doing lots of QE on other circumstances needs to be justified by an analysis of those circumstances. I don't believe that 2020-21 was a case for boosting demand. If you suddenly find that the supply potential of the economy is contracting, albeit temporarily, the last thing you want to do is to boost demand. And that's, I think, the basic mistake that was made. But it's because people have somehow said we don't understand what QE is. It's some new instrument. It's been used for decades, expanding or contracting the central bank balance sheet, not on the scale in which it's happening now, but certainly qualitatively. I think, therefore, the problem is it's better to move quickly when you feel you're seeing a big change in circumstances and take the appropriate action. But you have to analyze it and tell a narrative to people as to why this is the appropriate action. What you need to avoid is central banks saying, gosh, there's some bad news here. I better jump in and do something to demonstrate that we're here, that we're out there to help people. But if you provide help in the wrong form, then you see what follows. From today onwards, I think having allowed inflation to rise and then having had the bad luck of the extra boost to inflation following the Russian invasion of Ukraine, I think it's too late now to be, trying to fine tune this. Words like soft landing just have to be abandoned at present. And you just have to show your determination to raise rates, even though that is quite likely now to be in a recession.
Thank you. Claudio, I'd pose the same question to you. There's an inertia in policymaking. We saw that last year. How do you think now about the risks of, if 75 becomes the new 25 and you end up in a place where you've gone too far, or maybe that's the right risk to take at the point where you have inflation as high as it is? I'll turn to you.
I think that my answer in terms of the risks now is similar to the one that Mervyn gave. For the reasons that I mentioned earlier, this tendency for these transitions to become self-reinforcing, the fact that, and this was mentioned before by Tyler, models for a number of reasons don't really work when you have these transitions. I think the risk of doing too little is bigger than the risk of doing too much. And I expect that central banks will continue tightening until they see that inflation is coming down. It's coming down at the right speed, and it's coming down towards the objective. So I don't think that there is a risk that they will be doing too much. What I would also add that maybe it's easy to get inflation. It's easier for a number of reasons to get inflation from 8 to 4. But I think the longer this inflation persists, the harder it's going to be to, if you like, the last mile to get inflation from 4 to 2. So all of this speaks in favor of forceful and timely action.
Thanks. And Tyler, given the presentation you just made, I'd ask you the same question. How do you think about the the two-sided nature of risks that central banks could confront here at some point?
Right. So I think that there are 3 reasons why there's an asymmetric. There's going to be an asymmetry in terms of the risks, 2021 versus 2022 and beyond. So in 2021. There was a confusion of a supply and demand shock. I mean, what we had was a supply shock, which was matched with a demand response. Secondly, as both Mervyn and Claudia have mentioned, there was a reliance on models which are going to struggle at moments of regime change. And our co-panelist Larry Summers recently had his RA use the Fed's premier dynamic stochastic general equilibrium models, and also ran with their main model of FERBIS, and plugged into FERBIS a 10% deficit financed fiscal stimulus, ran it for, I think, 3 years. And at the end of 5 years, the increase in the rate of inflation was 75 basis points. So there's something wrong there when that is what your model is generating. Purely deficit financed 10% annual stimulus for 3 straight years. Third reason that I think that there was a miss in an inertia in 2021 that probably won't be replicated in 2022 and beyond is the observation of the late Alan Meltzer writing about the policy failures of the great inflation, the origins of the great inflation. So writing in 2005 on the origins of the great inflation, Meltzer wrote that policymakers denied for several years that inflation had either begun or increased. They did not deny the numbers they saw, but like Gardner-Ackley, CEA chair, they gave special explanations, a relative price theory for the general price level, in effect claiming that the rise in the price level resulted from one-time transitory factors that they did not expect to repeat. Later, they added other explanations, especially that the cause of inflation had changed from the classic demand pull to the new cost push, which may sound familiar for recent years. And then finally, I would just say that on the prospective front, I think there are a couple reasons why we should not expect similar inertia. One is that the gradualism doesn't really make sense the way it did in the aftermath of 2008, 2009. That was before inflation had risen above target. Inflation is now already well above target. So I think a case can be made for, instead of gradualism, raising the nominal rate by enough to actually tighten ex ante real interest rates, instead of this sort of incremental approach that I think was more appropriate for the last war.
Thanks, Tyler. So Mark asks on the event page, and this is a question from Mervyn King. He asks, Mervyn, what alternative monetary strategy should have been taken during the COVID event that would soften the now post-COVID inflationary pressure?
So I think 2 things. First, that central banks could have acted as a market maker of last resort in the markets that they were concerned about. We did that during the financial crisis in central banks offering to be a market maker of last resort. And that in the end didn't require large interventions in terms of sales or purchases. So that would have dealt with the particular problem of financial dislocation in March 2020. Secondly, no additional QE, certainly not have done any additional QE at all. The fiscal response, I think in the States you can debate and say it was too large, but I think the furlough schemes in Europe were highly appropriate, but I think central banks doubled down on all this by doing vast amounts of QE when there was no obvious need to do so, because as Tyler pointed out, it was both demand and supply were moving pretty much together all over the place in unpredictable ways.
And there's a question here from Corey on the event page. She asks Claudio or any of the others, she says, based on history, what do you think different targets central banks ought to look at? Inflation, nominal income, average inflation. Do any targets stand out to you as better than the others?
I think that depends very much. I would just, if I had to choose, I would say that it is important for central banks not to lose sight of what is happening to credit, and in that context also monetary aggregates. There is information in those aggregates, particularly here I may differ a little bit from Irving, but we could have a longer discussion about this. Particular credit I think that for the reasons that I mentioned earlier, it can give you a sense of whether financial expansions are sustainable or not sustainable, and what is going to happen to the economy. But I would say that whatever system you put in place, I think that the key, and again, this is a personal view, but the key is to have something which is not asymmetric, that does not result in a bias over time. Monetary policy that it is more, not just countercyclical on the way down, but a monetary policy which is also countercyclical on the way up. And then the question is exactly how you achieve that. There are different ways of skinning a cat, but to me, that's a key principle that is important to take into account when designing policy.
I want to follow on that and pose a question to Tyler, which is, some of the most controversial, or they seemed to me controversial at the time in March of 2020, when the Fed was announcing that it would purchase corporates and munis and do direct lending to middle market businesses. This was enabled through the CARES Act, and Congress gave a lot of equity to the Treasury Department to backstop losses. But as we sit here today, and then I'll ask after Tyler the other panelists to weigh in, how do you think today about the moral hazard concerns of having done that, of expanding the credit role that the Fed was taking on in the crisis, and whether the Fed bought junk debt ETFs in April of 2020, or announced that they would do it, bought them only in small amounts. But how do you think now about the risk reward or the cost benefit of having done that as we sit here today, 2.5 years later?
So I can understand the motivation of the Fed to ensure that in the face of the biggest macroeconomic shock since 1932, to ensure that there was a continued provision of capital and that liquidity was maintained. I would nonetheless say that a lot of what both the Federal Reserve and parts of the CARES Act did were treating a supply shock with demand instruments. And in the context of March, April 2020, we were faced with what was an exogenous shock. I mean, this is not like 2008, 2009, where this is a shock generated by errors in the system. This was an exogenous shock from a natural cause and a government-imposed restriction. And so the moral hazard is going to be somewhat attenuated relative to, for example, the interventions of 2008, 2009. I would add that I think the experience of 2020 ought to remind us of the importance of some of these supply side measures to, in the face of a transitory shock like a pandemic, to focus on some of those measures that can preserve some of the supply side potential of the U.S. economy, and preserve, in particular, the matches of employers and employees, so that you don't sever those matches, because once those are severed, then labor and product markets are going to be operating below potential while new matches are discovered. And secondly, there's a lot of organizational knowledge, a lot of organizational capital that's embedded in small enterprises. And if those if those go insolvent, then all that organizational capital is lost, and it can take some time to reconstitute. So I think that for me was one of the big lessons of the policy response of 2020, was emphasizing the preservation of some of those matches that existed on the eve of the pandemic.
Claudio, I'll pose that question to you. As you think about sort of the extraordinary credit market interventions the Fed took, were the risks worth, maybe we won't know until the next downturn, the next crisis, but as you sit here today, how would you evaluate those trade-offs?
Well, first of all, as you can imagine, Nick, I cannot really express views about the policies followed by any specific central bank, and particularly normative views about those policies. Now, what I can say is that clearly the risk of financial markets becoming too dependent on the actions of central bank is something that policymakers are aware of. And it is indeed a risk that one should try and avoid, because obviously otherwise it sort of constrains your policy too much, and over time you might end up in a place where obviously you wouldn't like to be. And then, as that saying goes, I mean, if you ask, well, if I were you, I wouldn't start from here. So that's precisely what one has to avoid, is that individual steps that you take in the short run in response to very specific circumstances don't take account of the longer term consequences that there may be.
And Mervyn, I'd ask you to weigh in as well.
So I'm not enthusiastic about central banks buying private sector assets, or indeed assets issued by levels of government below the federal level. I think central banks should focus on buying only assets issued by the federal government, and its other activities should really be about lending against collateral with appropriate haircuts. When I was still at the bank, I had to give evidence before a parliamentary committee, and they said, well, why don't you just buy assets issued by small businesses, because that would lead to tremendous success by those businesses. And I said, I gave the general argument that central banks should not be allocating credit between different sectors. And they said, no, but it would really help, wouldn't it? And I said, well, yes, I can give you the name of a small business in the Midlands, which if we were to buy either debt or equity issued by that business, would I guarantee lead to a sharp rise in business and consumer confidence right across the Midlands. They said, well, do it. And I said, when I tell you the name of that business is Aston Villa Football Club, you may be less enthusiastic about it. And they did. They said, you can't do that. That's your team. And I said, yes, well, that's why I personally might quite like to do it, but it would be wrong to do it. And they saw the point. You should not get involved in the allocation of credit or making judgments of that kind. If the government feels it's necessary to buy assets of particular, either the lower levels of government or the private sector, then the government should be the decision-making body. The central bank can always execute transactions, but it shouldn't be taking upon itself decisions about how to allocate credit. I'd just like to make one comment on the earlier question about targets. We abandoned intermediate targets for good reason, because as Chairman Powell said, they're always altered by structural changes in the economy. But it's a very different thing to say we're not going to have a monetary target, which I accept. I think I'll be wrong. Than to say, well, we're not going to look at money or credit at all. And I share Claudio's view. I think we should look at money and credit. And I think the role of a central bank is to tell a story, a narrative, which brings all these key developments together. And if you find that the growth of money because of your own actions is expanding by over 20% a year, you need to explain why you think that will not lead to any rise in inflation, if that's what your objective is. So I think that an inflation target, it achieves very much the same practical purpose as the Fed's dual mandate. I wouldn't change that at all. Messing around with mandates is a dangerous thing to do. But what you need is to focus the central bank on saying, we will be held accountable in the end for our performance on inflation. And that's the virtue of the inflation target. It constrains the inevitable discretion that central banks have to exercise to deal with changes in the structure of the economy that lead intermediate targets to be unhelpful.
Thank you for that. So Jose asks, is the inflation that we are experiencing a monetary phenomenon? And I'll ask the panel and we'll go in reverse order. So Mervyn, I'll come back to you first on that one.
Well, to some extent it is. I think the rise in core inflation on this occasion is. You can tell the story in various ways. You can tell it in terms of a labor market. You can tell it in terms of aggregate demand being too high relative to potential supply during COVID, which has led to a rise in core inflation. Although, as Chairman Powell emphasized, that's not happening now. So we're not generating higher inflation at present. That's the challenge, that having allowed it to rise, we're going to have to confront it, but it is going to go down of its own accord, I think. Or you can explain it in terms of what happened to the money supply. And if you're interested in asking the question, what should policy have done? I think it helps to look at the policy instrument that was used, which was QE, which led to a direct increase in the money supply. It would have been nice had we been able to look through the rise in inflation contributed by higher food and energy prices globally. But I think we were not in a position to do that, given the rising core inflation that's taken place. Whereas in 2010 to 13, when the Bank of England saw a 25% depreciation of the currency because of the financial crisis, we were able to look through the impact of that on domestic prices over a 3-year period and explain why we would accommodate that, because domestically generated inflation was under complete control and was not threatening the target. And after that 3 years or so, inflation did indeed come right back to the target. The unfortunate thing about the present situation is that domestically generated inflation has gone up, which means that central banks cannot simply look through the rise in food and energy prices. They certainly don't need to bring down inflation to deal with the 10% inflation, but they've got to get on top of the rising core inflation.
And Claudio, same question for you. Isn't the inflation that we're experiencing a monetary phenomenon?
Actually, my answer is similar to Mervyn's. I would say it is definitely a nominal phenomenon. That's what inflation is about. And I agree with what Mervyn said before, that you can't really explain inflation but just looking at real variables. In some cases, it can actually be quite dangerous to do that. Therefore, you have to. You always have to restrain nominal purchasing power in relation to the ability to the capacity of the economy to produce things. And so, in one way or the other, there is always an accommodation of the increase in the nominal purchasing power of the economy as a whole, and that's why we say that inflation is a monetary phenomenon. It is up to, and that's why central banks we assign it to central banks, because central banks can limit the expansion in the nominal purchasing power of the economy. They're not the only ones, but definitely they can and they should.
Tyler?
I think I would have to come down on the side of the central bank's error being primarily one of permission rather than commission. Because if you look at an apples to apples comparison of core inflation in the United States versus, say, the Euro area in the 12 months through February 2021, they were running exactly even, actually slightly less in the United States, 1% versus 1.1% if we take a harmonized index of consumer prices. March 2021 is when we get a divergence. And it's a big divergence starting in March 2021. What happens in March 2021? In the US, while consumers are already sitting on about $1.7 trillion in above trend savings from prior relief packages, we then have a fiscal stimulus equal to 10% of the annual output of the entire US economy. And the immediate impact of that is that demand for goods in the United States, which had already risen slightly above trend by the end of 2020, demand for goods in the United States surges by almost 11% month over month. That is a 240% annualized rate of increase in demand for goods. That is a lot. And we heard a lot of discussion of ports and supply chains in 2021. I actually think our ports did a pretty good job handling a demand shock of that magnitude. They actually handled import volumes that were 20% above 2019 levels. I think this was just a big demand shock that was accommodated by the policy posture of the Federal Reserve. And since 2021, now we've had some convergence between the Euro area and the US, driven primarily by energy and food in Europe. But the initial divergence was March 2021, and that was really what set the expectations ball rolling in the US.
So I'll use this as the last question here, since we only have a couple of minutes left. And Claudio, I'll leave you out of this, given your earlier disclaimer. But someone asks, when do you think inflation in the US is most likely to return to 2%? So I'll ask Tyler and then Mervyn for their views on when we might actually expect, when is a reasonable time frame to expect inflation, and I'll stick with core PCE here, to return to 2% in the US.
Well, thank you, Nick, for clarifying, because I was going to say by which measure. So I think it's unlikely before 2025 that we get core PCE down to 2% or below on a sustained basis, and in part just because one looks at the inertial components of PCE or CPI inflation, and we're seeing a lot of pressure on services. And those at the end of the day, services constitute the majority of the U.S. economy, and so that means that even a 5% decline in goods price inflation is going to be completely offset by just a 1% increase in services price inflation. And we see a lot of this in rents, owner equivalent rents. I think that there's a lot of services pressure that's going to take some time to bring down. And I would just note, sort of hearkening back to an earlier question today, in terms of the Fed's response moving forward, if you look back to the experience of the 1970s, on no fewer than 4 occasions, the Federal Reserve decided, all right, this is it. This is when we get inflation under control. And 4 times they either paused or U-turned. And the lesson of the 1970s was, unless you are actually named Paul Volcker, there's a high probability that you pause or U-turn before the task is done. So I think before 2025 is not impossible, but on a sustained basis, unlikely.
And Larry is not here, so I can't ask him. But Mervyn, I'll come to you. Any view on when we might actually see the Fed hit its target?
I don't make forecasts, Nick. It's a terrible mistake to do that. I'll just say one thing. There's no reason why it shouldn't be possible to reduce core inflation to the target in a couple of years. As Jay Powell said earlier, monetary growth is now, consistent, I think, with the target. If that stance is maintained over the next couple of years, we don't know what the Fed will do, but there's no reason why core inflation couldn't come back. But what will actually happen, I think, is very hard to judge. Much will depend on the events in the rest of the world, food and energy prices. I said you can easily paint scenarios in which inflation either goes to double digits or actually is down to 0, depending on what happens to these immense shocks. And just remember, every economist who made forecasts on the 1st of January in 2020, when we didn't know there was a pandemic, got it wildly wrong. In 2021, we didn't know how quickly demand would rebound. And in 2022, we didn't know on the 1st of January that Russia was going to invade Ukraine. Making forecasts is a mug's game, and I don't intend to join it.
Fair enough. Well, I want to thank our panelists for spending time with us today. That is all the time we have. I also want to thank the audience for joining us. And Cato will be uploading Larry Summers' video presentation online after the conference. So you can come back to the webpage for the conference or the YouTube page for Cato, and you should be able to watch Dr. Summers' remarks. We will now move to a 15-minute break. Please join us back at 11:30 a.m. Eastern for panel 2, the Fed's operating system and new monetary framework and appraisal, moderated by Neil Irwin of Axios. Thank you all so much.
Today, I would like to share some perspective on
Well, that did not go very well. Let's see. Should we give a second to see if Patricia's able to get back on or go straight to our panel? Just as a reminder, audience members can send in questions on Twitter with the hashtag CatoMonCon, also on YouTube, Facebook, and Slido through the chat boxes, including on the Cato website. Any sign of Patricia being back? There she is. Okay.
Hi, I think we had a connection issue there a moment. I'll pick up where I left off. So let me start off by saying the success of any implementation framework depends on its ability to work within the money market ecosystem to achieve interest rate control. For many years, the Fed funds rate has remained within the committee's target range on almost all occasions and has been responsive to changes in administered rates, including when the committee raised its target range this year. The Fed funds rate has also remained correlated with other overnight rates, a hallmark of effective interest rate control. I would highlight 3 ways in which the ample reserves regime's flexibility helps it adapt. First, it aims to supply reserves in the amount demanded by banks to meet their liquidity needs. Following the global financial crisis, banks fundamentally altered their liquidity management practices, and the largest banks now hold much bigger liquidity buffers. Although banks can hold a range of high-quality liquid assets, reserves are the safest and most liquid asset to meet immediate outflows. Supplying reserves in the quantities demanded ensures that administered rates provide strong incentives in money markets. Banks' demand for reserves can vary over time, and direct trading between banks, which can quickly redistribute reserves, has become less favored by many institutions. These dynamics suggest that maintaining ample conditions requires supplying reserves somewhat in excess of the amount that individual banks would minimally want to hold on a typical day. Second, the ample reserves regime allows for more variability in the Fed's other liabilities, which helps maintain rate control when shifts in these liabilities change the supply of reserves. The U.S. Treasury's account in particular can vary significantly, and the framework can accommodate such swings without active management of reserves. Third, the ample reserves regime can accommodate policies that expand the Fed's balance sheet. For example, asset purchases to foster accommodative financial conditions are now a standard tool of policy employed when the Fed funds rate is constrained by the effective lower bound. The committee's ample reserves framework has been resilient during the extraordinary period associated with the pandemic, providing effective rate control when the balance sheet grew from $4 trillion to nearly $9 trillion. During this period, interest on reserve balances and the overnight RRP worked together to support rate control, and growth in the ONRRP balances broadened the base of Fed liability holders beyond banks. Nonetheless, the substantial expansion in Fed liabilities since the pandemic is not a permanent feature of the framework, but a result of balance sheet policies employed to support the economy during a time of exceptional stress in financial markets and a deep economic downturn. It's the path to a smaller balance sheet that I would like to discuss next. Early this year, the committee issued principles for significantly reducing the size of the balance sheet as part of its plans to tighten the stance of monetary policy. And in June, the committee commenced runoff. An increase in the pace of balance sheet reduction is underway, with monthly redemptions under caps of $60 billion for treasuries and $35 billion for agency MBS. The decline in SOMA can be tracked through public data sources, as described in a New York Fed post published this morning. The Fed has prior experience reducing the size of its balance sheet. Between 2017 and 2019, the balance sheet shrank by $700 billion. This runoff proceeded smoothly during the period when reserves were ample. However, the Fed's balance sheet is considerably larger than it was then, and the pace of runoff will be faster. The composition of liabilities is also different. Current ONRRP balances are around $2.2 trillion, much larger than the roughly $125 billion at the start of the last balance sheet reduction. This different composition in liabilities is likely to require more complex adjustments in private sector balance sheets than during the last episode. However, just as use of the ONRRP expanded as the balance sheet grew, shifts in money markets that accompany balance sheet runoff, along with incentives provided by administered rates, should result in ONRRP balances declining from current levels over time. The relative pace at which reserves and ONRRP balances decline will depend on the actions of a broad range of money market participants, and these adjustments are likely to take time to play out. While ONRRP balances may remain elevated in the near term, we are already observing some modest shifts in money markets. As a repo investment, balances in the ONRRP are influenced by the relative yields on alternative money market instruments. Over the first half of the year, declining Treasury bill supply and uncertainty about the path of policy put downward pressure on very short-term rates relative to the ONRRP rate, increasing the demand for the facility. In coming months, the supply of short-term investments may grow. Net Treasury bill issuance has increased by about $250 billion from its trough this summer, easing downward pressure on rates, and bill supply is projected to rise modestly through year-end. Over time, the faster pace of summer runoff may also expand money market investments by increasing the amount of securities funded in repo markets. Over time, greater certainty about the economic outlook and the path of policy may also moderate demand for the ONRRP. The weighted average maturity of government money funds has fallen notably in recent months, as funds limited their interest rate risk. As the outlook becomes more clear, demand for very short-term instruments should moderate. Banks also have an important role to play in the relative decline in reserves and the ONRRP as they respond to the changing environment by shifting their liability management. Year to date, reserves have declined by a little more than $900 billion, as many banks felt comfortable allowing their balances to fall. With $3.1 trillion in reserves still in the system, most banks continue to maintain significant amounts of liquidity. However, in the current environment of rapidly rising short-term rates and expanding loan demand, there are some signs of greater competition for deposits and an increase in wholesale borrowing by some banks. Changes in behavior by banks have a broad influence across money markets. Greater advance demand lifts FHLB borrowing and expands the supply of money market investments. So far this year, FHLB discount notes outstanding have increased by around $230 billion. Higher deposit rates may also make bank deposits more attractive to investors. And over time, these dynamics should help draw funds out of the overnight RRP. Overall, as the Fed's balance sheet declines, I expect money market rates to rise relative to the ONRRP rate and for market participants to shift investments away from the facility over time, moderating the decline in reserves. The pace of this adjustment may occur at different rates across different institutions, depending on their responsiveness to changing conditions. Staff at the Fed will closely monitor money markets to help assess whether these adjustments are proceeding smoothly. Ultimately, the committee has stated its intention to slow and then stop the decline in the Fed's balance sheet when reserves are somewhat above the level it judges to be consistent with ample reserves. As I noted before, the level of reserves needed to maintain ample conditions is uncertain and varies over time. Bank balance sheets have grown markedly since the beginning of the pandemic, but it's unclear the degree to which banks' reserve demand has also shifted. In the most recent Senior Financial Officer Survey, Around 40% of banks suggested that the lowest level of reserves they would seek to maintain has increased since 2019. But nearly all of the remainder suggested that it stayed around the same. The committee has indicated that money market conditions will be an important gauge of when reserves are approaching the ample level. Staff will monitor a broad range of money market indicators. In addition, the standing repo facility is now available, along with the discount window, to address any shocks that may unexpectedly arise. I appreciate the opportunity to share some reflections on the Fed's operating framework. In recent years, the ample reserves regime has supported the committee's ability to address the extraordinary shock from the pandemic. I expect that it will support effective policy implementation as the balance sheet declines and going forward. Thank you, and I hope you enjoy the panel discussion that comes next.
Thank you so much, Patricia. Now to go to the panel portion, we're going to start with Kevin Warsh. He was a Fed governor from 2006 to 2011. He's now at Stanford. Kevin, the floor is yours.
Thanks very much, Neil. And thank you to Jim and the team at Cato for assembling us one more time. This is the most recent Cato conference, and as I can think about the conferences of the last decade or so, I can't help but think that some of the admonitions and recommendations that had been given, had they been put in place the last several years, we'd find ourselves in better shape. I think what Patricia admirably did there, Neil, was she described the technical, operational design features of the Fed's regime. What I'll try to do is complement that a little bit by talking about the architecture, by talking about the new monetary framework that the Powell Fed's put in place, for my own sort of views on that. I think first off, I think we should acknowledge the obvious, which is the Fed and inflation are on rather bad terms with one another. The gulf between central bank promises and the reality is as wide as I can ever recall. And the amazing thing about inflation is it's harming the real economy, but inflation harms the economy differently than many other things because it camouflages its own weakness. It appears as though nominal revenue growth for companies is fine, consumers are spending, but those are of course all in nominal terms. Inflation is the bigger threat to the US and the global economy than interest rates. And the Fed, as recently as a couple of weeks ago in Jackson Hole, seems to have gotten that figured out. Many of us have spoken about the risks of this current architecture in recent years. And I'll take the discussion today as our continued duty to speak clearly about this institution we hold dear. It's really up to Patricia and her colleagues at the FOMC whether this is a revenge of history moment, whether history will repeat itself or whether we will have learned lessons of the last decade and really of the more recent financial and business cycle. The American people are forgiving of those in power so long as the system advances the public interest. But to the extent that it doesn't, the challenges for the Fed and other institutions will be paramount. From where I sit, Neil, it appears that we have all the makings of a global recession. But from this moment, I see both more hope and danger than at any point really since the 1970s. Former Fed chairman, Neil, that you've interviewed frequently, often say that economic recoveries don't die of old age. And I think that's true. They're typically killed, and they're typically killed by substantial policy error. And it's up to us and those that are in power right now to decide whether this policy error is enough to do substantial harm to the economy. On the architecture front, there's two sources of policy error that are much discussed. I want to dismiss those before going to the architecture they put in place. The first explanation is, well, the Fed knew better over the last couple of years, but it was politics that kept them from doing the right thing. I don't agree with that view. First, my experience at the Fed is that politics don't find its way into that room. And the other piece of that I find a little troublesome is that somehow the Fed knew better a year or 2 years ago, and I don't see very much evidence for that. I think the second common explanation we hear about the Fed's current architecture is the Fed made a single bad decision, say a year ago in Jackson Hole, when they said this inflation is transitory and it will come and go. I don't believe that the problems that confront the US and the global economy are because of one misjudgment or one bad bit of timing. Instead, I think the Fed error is principally about sources and methods of the central bank to conduct its affairs. It's principally about the monetary framework that is in place, of which Patricia talked about the operating system that flows from it. And so just to put a fine point on the problem in the sources and methods the Fed's put in place, we can look back to the Jackson Hole regime that was put in place in August of 2020, just a couple of years ago. And in my view, that was a catalyst. That was the triggering event for the surge in prices from which we're suffering. Of course, as we all know, they put in place something called the fair average inflation targeting, but that was the shiny object. It strikes me the most consequential thing that they did then, which many of us spoke about, is they announced a new regime in which they basically said, we're going to ditch the idea of long and variable lags. If there was anything that academics at think tanks like this could have agreed upon in the last 40 years in the conduct of monetary policy, is that monetary policy works with these long and variable lags. Well, not so much and not anymore, the Fed said in their new architecture a couple of years ago. Policy they promised us would be inert until they fully achieved all of their objectives. They also told us that they would be data dependent. But as the data came in with inflation running hot for a very long time, they dismissed it at Jackson Hole just a year ago and said it was temporary. Those were among the failings of a new regime which they trotted out, which they said was a revolutionary new regime, an important change in policy. And that is, I think, indicative of the sources and methods of error they put into place. But I think that's just indicative. As I said, that was the catalyst. So let me, before I turn it back to you, Neil, see if I can nail down, I think, the four areas, the four errors of this new monetary policy framework, which are worth our discussion. And the first bucket is an intellectual error. There have been intellectual delusions around central banking and around the economics profession in the last decade or so that threaten common sense. I think Mervyn King spoke to it quite ably in the last panel. Inflation wasn't low for the period of the Great Moderation or even the period between the 2008 crisis and the 2020 crisis because the Fed ordered it so. I know of no particular theory that gives the Fed credit for moderate inflation over the prior 30 years, but somehow absolves it of the inflation that we're suffering from now. I think at core in this intellectual error, the Fed had to acknowledge in recent months that they do not have a clear theoretical or empirical understanding of the drivers of inflation. There seems to be great confusion about whether the inflation that we find ourselves with is structural or cyclical, whether it's born of domestic sources or comes from abroad. There seems to be a great aversion to the role of money. There seems to have been scant attention paid to the supply side of the economy. And instead, they seem to have been chasing this deity of R star, this neutral interest rate, which is unobservable and moves in response to policy. But those aren't the only intellectual errors that I think are the architecture of the last several years. I think the famed Lucas critique is applicable here as well. The Fed changed operating regimes in August of 2020, but they acted as though the inflation and output would act in this cycle much as it had in prior cycles. The reverence for their own models, especially the DSGE models, which were referenced in the prior panel, are indicative of the idea that they didn't take the Lucas critique as seriously as they should have. They claim that there is that they've been focused on imbalances. Monetary policy reports, financial stability reports for years have said that there are really no material imbalances in the economy. But when one restricts supply and subsidizes demand, inflation manifests itself. And the inflation we're seeing in the US and the global economy is, if nothing else, a result of material imbalances. So that's the first bucket of intellectual errors, Neil. The second bucket, institutional errors. The Fed's ambitions appear to exceed its mandate. While even this morning, Chairman Powell said that he stays out of the business of fiscal policy, and I think he dutifully tries to do so. But if we look at the game tape, the Fed weighed in fiscal policy in a very substantial degree. Not only in the darkest days of the 2020 pandemic, but in plenty of periods since. There's a kind of institutional vanity that comes when any institution wanders outside of their remit. There are injustices everywhere in the world, and the Fed has decided in recent years to opine on many of those injustices. That's one thing, but it's quite another to suggest that they have the tools and the operating system to do much about it. Well, many of the things that the Fed has talked about are worthy, are noble objectives and are worthy of massive improvement. It strikes me there's been a signal to households and businesses that the institution could be wandering from its principal objective of price stability. Being a central banker, and especially being the Federal Reserve, the most important of central banks, requires a resistance to whims, a resistance to fads and trends, no matter how worthy. So that institutional error strikes me, Neil, as the second broad set of concerns that need to be remedied to solve the price stability problems going forward. And just two more before I turn back to you. The third is an operational or organizational set of errors. I can't but help but notice, and I'm sure most of the people listening here, the amazing amount of talent at the Federal Reserve, as evidenced from Patricia and the people that guys like Vincent and I know around the FOMC. But somehow the sum is delivering considerably less than its parts. How could it be that merely 18 months ago, nobody in that room at the FOMC and the monetary policy deliberations thought there to be a single rate increase in Fed funds until 2024? How could it be that about a year ago, there was only an expectation of 125 basis point increase in Fed funds in the year 2022? My view is it can't be. Those were the numbers that were put forward in the summary of economic projections, but the diversity of views in that room is much broader than that. And I believe that it's an organizational reform that's necessary that can give air to the breadth of those views rather than keeping them in conformity. The best work on this subject was been done by Cass Sunstein and Tim Curran in language they describe as an availability cascade, where they describe a self-reinforcing cycle that explains the development of certain beliefs that go increasingly unquestioned. And it strikes me that is among the reasons why we have the problems that we do. Given this proliferation of objectives for the Fed, ultimately what they chose to do in this new architecture was they chose strategic ambiguity and tactical clarity. And I think they've got that precisely wrong. The strategic objective should be totally clear. Congress gave them the objective to ensure price stability and full employment, and they've had to acknowledge in recent years that price stability is the sine qua non of full employment. You can't have full employment with this kind of price instability. So the strategic ambiguity should be replaced with strategic clarity. And what about tactics? They've been very clear on their tactics. That's what forward guidance has been all about. But they've created so much transparency about their very next move, even as much as their move next week, that I think it's made it harder for them to navigate this changing terrain. And it explains why, while they might have acknowledged that they had the wrong policy last winter, it was not until March of this year, even as early as early March of this year, interest rates were still zero and they were still adding to the balance sheet that Patricia talked about. This sort of tactics has made it more difficult for them to do their jobs. And it strikes me that transparency is quite important. What's more important is getting policy right. And finally, if I think about the new architecture under this new regime, I think it fails from a fourth bucket of issues, and those are around risk management. They engaged in a policy of regime change under the Powell Fed because they were, in their own judgment, missing their inflation target by about 0.3%. That is, inflation was running at around 1.7% instead of 2.0%. And they went on to claim that this low level of inflation, this miss, was, quote, the greatest challenge for this generation of central bankers. I think that that's a problem of risk management. If missing an inflation target by 0.3, when we can barely calculate to the right of the decimal point what's happening in the US economy, and can be certainly imprecise about the level of inflation at any point, it strikes me that we're not measuring risks correctly. Ultimately, the job of the central bank is, as Milton Friedman reminded us 40 years ago, is to minimize what he called substantial deviations in output and inflation from our objectives. And that 0.3% from which we changed operating regimes is not, in my judgment, anywhere near substantial. Ultimately, the Fed put too much emphasis on modes and not enough emphasis on risks. And ultimately, if we think about the response to this inflation scare, it looks to me quite slow in comparison to the reaction of the scares they had in 2008 and 2020. And so again, had they acted sooner with a better risk management framework, I think we could have avoided some of these substantial problems. So in closing, Neil, I'll put it back to you, but say we saw a regime change in the conduct of monetary policy a few years ago. It will require another wholesale regime change in the conduct of policy to get out of this new period of price instability. And I'm hopeful that what we heard from the chairman at Jackson Hole about 10 days ago is indicative of that new regime change. I struggle to reconcile what was said in Jackson Hole from what was said at the FOMC meeting a few weeks before that. But if what we do is turn the page to a new regime in Jackson Hole and we follow it up over the course of the next several weeks and months, well, we can't mitigate the harm that's been done to this point. I think we can be on a far better path and try to live up to the objectives that Congress gave the Federal Reserve.
Thank you, Kevin. We'll now hear from Vincent Reinhardt. He was used to be the head of the Fed's Monetary Affairs Division. He's now chief economist and macro strategist at Dreyfus Mellon. Vincent.
Thank you, Neil. Thank you, Neil. I think I successfully shared some presentation, which I'm going to go through very briefly. And everyone can hear me and everyone can see this? Okay, thank you. So thanks for that reassurance. Thank you for the opportunity to participate once again in this Cato Monetary Policy Conference. And I want to commend the organizers for combining a discussion of the Fed's framework, i.e. policy in the large, and the operating system, policy in the small, because they share a design flaw that's derived from the Fed's flawed understanding of what happened to us in the pandemic. So it's really not surprising if you get the big thing wrong that it shows up elsewhere. And that's why my conversation is going to be the Fed's flawed choices in the large, in the small, and technically under the law. And what's the big thing? The big thing is the Fed was totally focused on the management of aggregate demand, even though the other discretionary authority was more than overstimulating it. And the pandemic was actually a sectoral shock. In that regard, I'm turning to the next page, page 2. The response to the pandemic was a withdrawal from market activity. Some of it was voluntary as people were worried about health outcomes. Some of it was mandated by the government, also worried about husbanding health resources and its own reputation. That meant it was a withdrawal from market activity, both as producers and purchasers of goods and services. Note the components. That means it hit both supply and demand, and it hit sectorally goods and services. And in fact, it did so to an uneven amount and to a different extent over time. Now, note the important difference between goods and services. Services tend to be more personal and extend exposure to providers, i.e. think of the hairdresser, and are complementary to much of other service activity, i.e. think of the transit worker and the person who serves the coffee to go. Both services and goods were hit hard, but services employ 4/5 of the workforce. And the hit there was a more consequential for economic activity. There's a couple other important differences. The first is services are of the moment, right? They only turn into output if there is supply to meet demand. Moreover, services can't come from inventories and can't come from abroad. So the sectoral shock, because of what it did to workers' incentives and what governments told workers, sets up this problem for the Federal Reserve. And in two regards. In the large, the Fed viewed this as a problem in the management of aggregate demand, but not neglected the ongoing fiscal replacement to aggregate demand, and it also neglected the sectoral incidents. Left panel addresses the fiscal impetus, which was immediate and massive. Yeah, so much for the recognition and implementation lags that you read about in textbooks. The left panel plots 4-quarter real gross domestic product and 4-quarter real disposable personal income. And look at the first half of 2020. GDP contracted near at a double-digit rate, but real disposable income increased at a double-digit pace. So as a nation, this was the largest gap ever between what we produced and what we gave ourselves, i.e., aggregate demand was provided by the fiscal authority. Moreover, aggregate demand replacement really shouldn't have been the problem, and that's about the right panel. Why? Supply of services just weren't there as workers withdrew from market activity. So extra income was either saved or fell onto goods demand. And we see that the smaller portion of our economy that produces goods actually produced well above trend or sold well above trend. Goods demand increased markedly because of the extra income and the inability to spend it on services, because services fell well below trend and stayed well below trend on a persistent basis. There was something like a 2 percentage point shift in the household consumption basket, which is massive. So macro policy dislodged the ongoing trend in goods consumption relative to services consumption. The support to goods demand, which could be met by pressing on supply, that is, getting it from inventories and abroad, dislodged the decade-long trend in relative prices. The upper panel plots the absolute price index for goods. That's the red line. Services, the blue. That's the blue line is goods. Services are red, and the total is the darker line. Look at the light blue line over the last 20 years. The level of goods prices just before the pandemic was the same as it was in 2008. In most of this 20-year span, the average inflation rate of goods prices is close to 0. 3/4 of the years, it is below the Fed's goal of 2%. If you have goods prices inflation pulling down the total, you can allow service inflation to be above the goal. That was the wind under the wings of the new monetary framework. When 3/10 of the price basket is pulling inflation below goal, the Fed could run the economy hot and let service inflation go above goal. Hence, the framework that Kevin talked about, rolled out with great fanfare in 2020, was one-sided, was admitted overshooting, and was complacent about misses by emphasizing historical averages when you would have thought bygones were bygones. Also, the 2-decade experience explains why the recognition lag was so long. if you always expected goods inflation to pull down the total, then you might be on team transitory. But goods inflation was adding to the total, having propped up overall demand for goods. The Fed basically allowed inflation to creep in to the more persistent component. And not just allowed it big time. Look how high goods inflation is now relative to the total. That is what has to be pushed back against. Now, with regard to the implementation of policy, I do want to emphasize two parts. And that policy support obviously was the support to aggregate demand was both conventional and unconventional. By this time, unfortunately, we really have to put air quotes around the unconventional because it has become commonplace. I admit, full disclosure, when we wrote with Ben Bernanke about how to do unconventional policy 20 years ago, we didn't think it would become commonplace, and we neglected to include the sections on the risks to the policy and how to exit the policy. That's consequential now. This chart's a one-stop shop for thinking about the stance of monetary policy. The vertical axis is the size of the Fed's balance sheet, i.e. unconventional policy. Horizontal axis is the federal funds rate, conventional policy, inverted though. And so what that means, going from the southwest corner to the northeast, is policy accommodation. You're cutting the policy rate and you are amping up the size of the balance sheet. The lack of recognition about sectors, the concern that it was all about overall assets, the amount of reserves and making sure they were ample, led the Fed to neglect the sectoral aspects of what it was adding to the balance sheet. That is, the way in didn't account for the way out because of what they were buying, nor what they were buying, how what they were buying was affecting what they were seeing and what was happening in sectors of the economy. This chart looks at just the Fed's, a snapshot at the end of 2019 of the Fed's balance sheet and the total market share, and also the Fed's share of the total. The important things in yellow. How much of the overall net issuance did the Fed buy in its quantitative easing? The answer is a large share of everything, but an increasingly large share as you get more illiquid. The Fed bought inflation index securities more than the Treasury issued on net, and mortgage-backed securities, 4/5 of the total issuance. Those securities trade in illiquid markets. With regard to the inflation index securities, it's not obvious why the central bank should be protected from inflation, nor should the central bank be muddying the waters for a market in which it says it gets important readings on real rates and inflation compensation. And the purchase of mortgage-backed securities further overheated a market that was already overheated. It was an encouragement to a goods demand where the problem wasn't goods demand, i.e. notice the increase in house prices at the right. One last point, and the Fed emphasizes in everything about how aggressive the way out is, i.e. the red line in the chart, the one-stop shop on monetary policy. Because the baseline is expressed as Pat said at the left. The Fed is limiting the amount of securities it rolls over at auctions so that the balance sheet shrinks over time. I, however, have a question for you, and that is when you look at the Federal Reserve Act, why is the Fed participating in auctions to begin with? The Federal Reserve Act places the limitation that principal and interest may be bought and sold without regard to maturities, but only in the open market. By saying that the Fed can roll over maturing obligations at Treasury auctions, it sets up it frames the baseline as the aggressive decision not to roll over everything. But an originalist reading of the Federal Reserve Act would lead us to conclude everything should get rolled over. And as a consequence, it would be a larger amount. And then the Fed would have to make a decision whether to do open market operations to replace some of what would be rolled over, i.e., they'd have a much harder discussion as to why it was purchasing assets in the secondary market at the same time it was raising the policy rate and emphasizing it was shrinking the amount of reserves. Because it rolls over securities at the auctions, it gets to do that behind the curtain. Those are my remarks. Thank you.
Thanks so much, Vince. Before we go to George, just a reminder, if you have questions, you can put them in on Twitter with the hashtag CatoMonCon, or on YouTube, Facebook, Slido on the chat boxes in the Cato website. George Selgin is a senior fellow at Cato. Let's hear from George.
Thanks, Neil. And thank you all for this opportunity to speak about the Fed's operating system. My topic is more or less the same topic that Patricia Zobel was speaking on, but my take on it is going to be a little less sanguine. Many of you know Walter Bagehot as the author of Lombard Street, a book that outlined the principles of last resort lending. Some years before he wrote that book, Bagehot wrote the English Constitution. And in that book, he noted how England, instead of having designed its constitution from scratch the way we did, really just stumbled onto it over time. But that didn't keep the English Constitution from being something that, according to Bagehot, worked more simply and easily and better than any instrument of government that has yet been tried. Well, the Fed's floor operating system resembles the English Constitution in that it is also something that the Federal Reserve stumbled on. It didn't really plan to adopt it. It adopted it more or less accidentally in 2008. But that's where the resemblance ends, because the floor system has not turned out to be simpler than the previous corridor type system that the Fed had relied upon for a quarter century. It's turned out not to be easier in any other respects or otherwise better than that system or than other alternatives that might have been adopted and that might still be adopted in its place. And I want to explain with my remaining time why I believe all of these things. First, a quick review of the difference between a floor operating system and a corridor operating system. These are both arrangements through which the Fed establishes its own interest rate target and tries to reach that target. And then, of course, if it does, the interest rate that it targets will also determine more or less the setting of other interest rates throughout the economy. In a corridor type system, of which we had a version before 2008 in place, the Fed regulates its interest rate by altering the scarcity of reserves in the banking system. Reserves are scarce in a corridor system, that is, banks don't generally have more than they need to stay liquid. And by altering the available supply of reserves through open market purchases and sales, the Fed can make them more or less scarce at the margin. And as a result, banks will be willing to bid for higher prices to acquire reserves, or lower prices as the case may be. And the idea is that by manipulating the quantity of reserves, the Federal Reserve can get the overnight interest rate or federal funds rate target just where it wants it. In a floor system, in contrast, the Fed supplies banks with large quantities of reserves, with abundant reserves. Reserves are not scarce in that system. In turn, the Federal Reserve pays an interest rate on reserves that's actually equal to, this is in theory, in an orthodox floor system, equal to its target rate. And the idea is that if you pay banks an interest rate on reserves equal to the target overnight rate, then with an ample reserve system, that rate of interest on reserves will, through arbitrage, establish all other interest rates. So on paper, a floor system is very simple. You give banks plenty of reserves, you pay whatever your target rate is on those reserves, arbitrage takes care of the rest, set it and forget it. Well, as I said, the floor system that we have in place wasn't designed very carefully from the start. It's something that was stumbled upon during the great financial crisis. Briefly, the story is this. The Federal Reserve was engaging early in that crisis in a large amount of emergency lending. And it was trying not to have interest rates fall below a target it had established at that time, despite the reserves it was creating, large quantities of reserves through those emergency loans. At first, it engaged in sterilization of its lending, which meant it sold off other assets on its balance sheet as it increased its emergency loans. Eventually, though, those other assets, Treasury securities mainly, began to reach low levels of those. It had to do something else. It started paying interest on reserves as an alternative to get banks to hold on to the reserves it was creating with its emergency loans. At the time, some people inside the Fed said, you know, if we keep doing this, we might end up on a floor operating system. And others said, well, we'll deal with that if it happens. And the way they dealt with it was to make a floor operating system, to stick to that system, making it official in January 2019. So I say all this by way of saying, you know, when you stumble on something, it could work out well, as it did in the case of the English Constitution, according to Badgett, but sometimes it doesn't. And in this case, in the Fed's case, and I don't think it did. Now, Fed officials did argue that this switch was a desirable one because it kept things simple. Bill Dudley in April 2018 said the floor system is, quote, operationally much less complex than a corridor system because, quote, the setting of the interest rate on reserves is largely sufficient to maintain the federal funds rate in the FOMC's target range. So there you have the theory again. Well, in practice, has it been sufficient? Hardly, hardly. In fact, the thing has had to be supplemented by all kinds of fixes and amendments that now make it look kind of like a Rube Goldberg contraption. I just want to go through some of these other things the Fed has had to do to make its floor system do what it was supposed to do so easily. Back in 2014, the Fed had to establish its overnight reverse repo purchase facility. That's because the interest rate, the overnight rate, tended to sag below the bottom of the Fed's target range, instead of being, as it were, propped up by interest on reserves. What the overnight reverse repurchase facility does is essentially to create a subfloor beneath the floor of the interest rate on reserves that non-banks can access, non-bank counterparties, including especially money market mutual funds. Now, at first, this overnight reverse repurchase facility was used rather moderately, but over time, it's become more and more important. And now, the Fed is engaging in about $2.5 trillion worth of overnight reverse repurchase operations daily, $2.5 trillion. As opposed to a scale of ordinary open market operations, in this case, purchases of Treasury securities before the crisis, at a scale of about less than 20 billion a day, right? That's 20 billion versus 2.5 trillion. Right there, you have an indication of just how much more activity is involved in maintaining the current floor system. Other tweaks include changes in the Federal Reserve's target interest rate range. Now, it's pretty obvious that if you make the target range wider, you make it easier to hit the target, that is, any point within that range. Well, the Fed's had to widen that range several times. In theory, an orthodox floor system, you set the interest rate on reserves, and that's where your overnight interest rate will be. You shouldn't even have to have a range in order to hit the target. In practice, in the US, the way our system functions, the Fed not only had to start out with a range, it's had to expand the range through little tweaks in consisting of additions to the spread between the upper limit of the interest rate target range and the interest rate on reserves. It added a 5 basis points to the spread in June 2018, another 5 in January 2019, another 5 in May 2019, and another 5 in November 2019. So you got 20 basis points of extra spread to play with, because that's what they needed to do to make sure, or to increase the odds of hitting their target rate. They've since reduced that spread a little bit, but back then, 20 basis points, that was almost 10% of the going level of interest rates. So it's giving themselves a lot of extra room to play with. Most recently, in January 2022, the Fed had to set up a standing repo facility, a new standing facility, because there was a problem of rates spiking above the upper level, the upper limit of their target range, even with all the tweaking that the Fed had done. And so now you have had to have a whole new facility to guard against those spikes, which become particularly important as the Fed is trying to reduce its balance sheet, unwind its balance sheet in the aftermath of quantitative easing operations. Well, let's talk about the balance sheet a little bit. When the Fed officials were first arguing the benefits of a corridor, of a floor system, they estimated that it might take about $35 billion of total reserves to maintain and operate such a system. That was about twice the level of reserves held under the old corridor system. Well, they've had to modify that estimate a few times since. In 2016, they decided they needed at least 100 billion. In 2017, the figure was 500 billion. In 2018, it was 600 billion. In 2019, 1.3 trillion. Today, as Patricia mentioned, the reserves outstanding are at about 3 billion. And I'll bet you anything, we never see 2 billion again. The problem here, as some researchers have noted, is that banks tend to get used to having excess reserves, and lo and behold, after they have them enough, they stop doing the kinds of things that they might have done in the past to economize on such reserves, and also to prepare themselves in case a shortage should arise. So a floor system becomes a kind of addictive arrangement where the more reserves banks are used to having at their disposal, the more they need. And this is why it tends to be very difficult to unwind, and estimates about how low you can go end up becoming falsified. All right then, well, let's talk in my last couple minutes about whether the system is better. It's certainly not easier. It's certainly just as complicated. Well, you have a number of factors here that make it far worse. One thing that a floor system has done is kill the overnight unsecured lending market, the interbank market. So banks don't monitor one another. They don't know which other banks can be relied upon to borrow from or lend to. And that has had an adverse effect on market discipline. The floor system has raised the costs of government funding, because the interest rate on reserves is often higher than that of the treasury bills and other securities, except very long-term ones that might be used to fund government instead. The Fed is essentially swapping one kind of interest earning security for another when it creates reserves in the system. there's also the danger, which I've written about elsewhere, about a fiscal QE, that under this arrangement, quantitative easing can be abused for political purposes. And I think that, and that wouldn't be possible in a corridor system where it could only be resorted to when it's absolutely necessary because interest rates have hit their zero lower bound. And finally, when we talk about whether this system is easier, the most obvious question we can ask is, well, is the Fed saving resources? If the system worked the way it was supposed to, there should be fewer people working at the New York Fed to keep interest rates on target. Now, Patricia isn't here any longer, but I wonder what, I think I know the answer if I were to ask her whether they've cut back on their staff, researchers, or anything else connected with implementing and operating the floor system. If anything, I suspect they've got more people and more resources because it's a lot harder. The old system was not that hard. They operated it for 25 years without much difficulty. In short, if operating systems were like used cars, I think the floor system would qualify as a lemon. And I think that all the promises made about its advantages when it was being sold to the public would look like a bait and switch scheme. I don't mean that the Fed intentionally misled people. I don't think that's true. But what does bother me is that to this day, as we saw earlier, the Fed continues to defend the system as if it was working exactly the way it was supposed to, as if it had all the benefits that Fed officials expected it to have long ago. It's time for the Fed and for the rest of us to be aware that this system is not a good system, that we could do better, and we should try to do so. Thanks very much.
Thank you, George. Vincent, would you like to dive in and tell us what you agree or disagree with about George's rather harsh assessment just now?
So the first point I'd like to make with regard to what George identified really as the ratchet effect of ample reserves. What we defined as ample got bigger and bigger and bigger. Well, George, you said, well, banks get used to it. I think regulators and examiners get even more used to it and expect to see it on bank balance sheets. And in that environment, think how useful, especially they are in stress tests, which are where the money is with regard to decisions on capital adequacy and the ability for banks to buy back shares and pay dividends. So ample reserves are not set. They are determined not just by banks, but by the regulatory system, and the regulatory system isn't just a set of rules and rules. It's how it's interpreted and enforced in the field. A second part of it is, to me, I think I always fall back to the defense of where the Fed is now to say, I think that's what Milton Friedman wanted. That in an environment in which the cost of making reserves, the marginal cost for the Federal Reserve for making additional reserves is zero. Why do you have banks accommodate on holding reserves? Well, make the cost zero. You don't want, however, since it influences market rates generally, the alternative to accomplish that is to pay interest on reserves. That goes back to the Bach Commission in the early 1960s. So I get it, and I think to George's point, quoting from Bashir from the very beginning, is we haven't had a systematic discussion of this. I.e., it's just sort of happened and evolved. We're doing it because it was the set of instructions last time that got amended, and that'll get amended. And I think what we really need is a serious rethink. I'm not convinced, however, that rethink would necessarily move the Fed from where it is. And then the last point, Mayor, I think some of it is also just the decline of the primary dealer system as we know it. The dealer system was the way that the central bank, intermediated daily liquidity to the rest of the banking system. But capital constraints, regulatory requirements just don't make it real attractive to be a primary dealer. How else can you do it? Well, how about you have shiny new tools where you can interact more directly with more of the banking system, importantly, including the reverse RP facility.
Thanks.
That's it for me.
I want to pose a bit of a broader question that I'll send to Kevin first. In Jackson Hole a couple of weeks ago, I think we heard a lot of discussion about the possibility that these supply shocks we've been having the last couple of years, the pandemic, the war in Ukraine, the climate-related problems, that this might be a new normal, that it might be a kind of recurring series of supply-side shocks, in contrast to the 2010s when the problem was demand management and inadequate demand. Whatever you think of the flexible average inflation targeting framework, came out in August of 2020. It's pretty clear it was directed at what were viewed as the challenges of the 2010s, just at a moment when things were changing. So Kevin, first of all, if we are in a different kind of global macro landscape, is there a path forward to a new framework that can really make sense? You're muted.
Yep, sorry about that. I think there is a path forward. Remember, policy and policy frameworks are supposed to be forward-looking. They're not supposed to assume that the future will look exactly like the past. The Fed talks about the necessity of humility and being nimble. And that means you need to have a broad framework that can adjust with the times, as opposed to constraining yourself through an old regime made for a different moment, or constraining yourself by continuing to come up with new projections, which we'll see next week, that will make it harder for the Fed to adjust to a series of shocks that could happen on the supply or demand side. I think broadly, you're right in that the risks on the supply side in the period ahead are likely to be materially higher than one could have imagined a decade ago. If in some sense, the low inflation in the United States and around the world was a function not principally of interest rate policy, but was a function of demographics and what some people describe as one worldism, globalization that brought new workers onto the playing field and new markets such that we could keep, to the charts that Vince showed, keeps good prices down over time. I think there's good reason to believe that that period is behind us. The world is breaking into different spheres of influence, separate and apart from the Russian invasion of Ukraine, which probably only amplifies this effect. The world is building out new supply chains, new ways of doing business, and the world is developing a new financial system which is not integrated from east to west, but is bifurcated. That transition is likely to be difficult for the supply side of the economy, not just in financial markets, but more broadly in manufacturing and services, in the movement of workers and data across borders. So I share your instinct, which is supply shocks are more likely to be more persistent, and the Fed needs to use this moment in time to be as dogmatic as they were 10 days ago. It would have been better if they were as dogmatic a long time before. It says, we will ensure price stability. And behind that Jackson Hole remarks, they should be engaging in a lot of introspection across those four buckets that I described, so they are prepared to meet that moment with a new understanding of what's causing inflation and what they can do to ensure that the objectives given by Congress are lived up to.
Thanks. We'll go to a couple of viewer questions. Walter asks on the event page, George, people often critique politicians for pushing problems off on future officials. Does that same thing happen to the Federal Reserve? It sounds like what you're describing is that some took notice of the floor system, other pushed it off. Is there a pushing the can down the road issue afoot here?
Well, that depends. I think as I see things so far, it doesn't look like many Fed officials see the floor system as a problem. I wish more would. If they do, they're not admitting it. So there are two phenomena that might be, either of which might be going on. One is the kick the can phenomenon that you mentioned. The other one, which is certainly important, is the tendency for Fed officials never to admit that it's made any mistakes. this makes it observationally difficult to tell whether a later generation of Fed officials feels that they've been saddled with something with a problem that previous ones have created. You seldom find them saying as much. That's the issue. So I could speculate that there are Fed officials out there who really wish the Fed hadn't done all of this, hadn't taken this route, but it's not easy to uncover proof that that has happened.
Thanks. Why don't I go to Vincent with this question? Gary asks on the event page, how often is too often for the Fed or any central bank to change its framework? Is it? I'm expanding on Gary's question, but is it too soon to think about tossing out flexible inflation targeting and start thinking about something new?
So I would actually go back to George's point about whether you have a constitution or an oral tradition. The Fed's mandate is maximum employment and stable prices. It doesn't the law doesn't operationalize it. And so what the Fed FOMC hoped it would do is by repeating the mission statement often enough, it would become the rule of law because it was tradition. I.e., if you keep saying 2% is the goal, then it's going to be harder and harder for the next committee to not have 2% as a goal. Because in principle, just like any legislative body, the FOMC reforms itself every year and they could make up whatever they want each year. So the mission statement, the framework is supposed to, by the force of tradition, impose what the Congress is unwilling to do so. So to me, that means you never change it. They would have been better off if they just stuck to the Volcker-Greenspan definition of price stability as an environment in which the material changes in the price level are not influencing the decision-making of households and firms, and said that worked in the 80s and latter part of the 80s and the 90s, let's just keep it. That would have been the force of tradition. So how soon is soon enough? To me, it's never. However, don't enshrine what they got now.
Thanks. I kind of like this question from an anonymous user on the event page to Kevin. Can you expand on how we can keep the Lucas critique in mind when forming monetary policy responses? What do you mean by that?
Sure. So part of the reason why I think the Fed was confident that inflation over the last several years would return to 2% is because when we look back on history, which is inherently in the model and the models that are the workhorse models at the Fed, inflation really since the mid-1980s has kept falling to 2%. So no matter what you do operationally in monetary or fiscal policy, in the model in the out years, you get back to an inflation target because you prescribed it and history judged it. But what the Lucas critique reminds us of is that history will repeat itself, or has a good chance of repeating itself, if the operating regime repeats itself. If you change how you conduct policy, you change your objective function, you change your strategy, you change your tactics, there's no reason to think that the results in the model will be the same. In fact, they'll be quite different. So I think one way to think about that is to think about the workhorse models at the Fed, instead of relying upon them for forecasts, instead of using those as the anchor for the summary of economic projections that we'll see next week, instead of taking that as though it is a very good forecast of a complicated global economy filled with shocks everywhere, we use the models to gain insight. We do alternative simulations to see what we could do such that we missed our goals instead of made our goals. We stress test the models instead of just stress testing the banks. And so we use those models in a way that are more informative and more illustrative. And what's that mean, Neil, for the conduct of policy? Instead of focusing so much of the discussions to the right of the decimal point, that inflation will be 2.0%, that somehow economic growth the next four corners will be X. We put the emphasis on the left side of the decimal point. We understand that we can't fine tune an economy that is stuck with these sorts of shocks, that are going through these sorts of changes not just a result of the war and COVID, but as a result of radical changes in how business and capital markets are flowing, in part because of the change in the great power competition between the US and China. So I think in that sense, what Vince and I talked about many years ago when we had on a uniform like Patricia's is what if we were to use fan charts that showed the variance of outcomes? What if we were to describe our emissions and the uncertainties around it? What if the risks around our forecast were to be what we talk about rather than the modal forecast itself? Those are the sorts of changes you'd need to be incorporating to recognize that when you change regimes, the outcomes are likely to change as well.
Thanks. So I'm going to combine a couple of questions for Vince. Is there a right size for the Fed balance sheet? Is there, at the kind of scale we're at now, is it inherently going to fuel asset bubbles? How would we even answer that question of what a right-sized Fed balance sheet looks like as the economy stabilizes?
So the answer is there is no right answer. When for Volcker, it was about 5% of nominal GDP. It peaked up close to 25% of nominal GDP. The right size of the balance sheet isn't really about the operating system. Depending on how you move your administered rates, you can take account of that. The right size of the balance sheet is really a question about the political economy, i.e. a bigger balance sheet is the Federal Reserve creating fiscal space for the Treasury. Is that a job you want your central bank to be in? So on the economics, it's not a question about the economics of the balance sheet. It's a question about the political economy of the balance sheet. And I think that's why a lot of people are rightly worried when the balance sheet gets so big.
If I may, I'd like to add to what Vincent said there, that I really think it's an unappreciated virtue of a corridor type system that you can have quantitative easing when it's macroeconomically desirable, which is when interest rates hit their lower bound. In fact, in that case, a corridor system becomes a floor system quite automatically, just when you need it to, because it's at that point that lowering interest rates in the usual fashion ceases to work. Whereas a floor system, it allows quantitative easing when there's no macroeconomic reason for it. And that means that politics can have a much greater bearing on the size of the balance sheet, typically by making it bigger than it ought to be or might be. And I see this as a very important disadvantage of a floor system.
And let me just say about section 14, which is the part I quoted, going back to, if you read like Meltzer's history of the Federal Reserve, there really was an originalist small Fed view. And what the law wrote in was automatic shrinkage of the balance sheet over time. Yeah. What the Fed interpreted, how the Fed interpreted the law gives them more discretion than I think the founders intended.
And Neil, if I might just join in with a comment that I think combines both George and Vince's statements. I think the operative question is that most of us believe that in times of exigent circumstances, that's what the Fed's role is, to stand in the breach when there's a shock like 2008 or 2020. And so most of us are open-minded then to expanding the Fed balance sheet, providing liquidity in markets. The troubling part is there has to be some symmetry to that. During the long period between 2010 and 2020, there was plenty of openings for the speed and duration of those assets to be unwound. The concern as we look now is it looks like the balance sheet only really ratchets in one direction. What I think many in financial markets believe is that Patricia and her team have begun a modest wind down of the Fed's balance sheet. But I suspect today the balance sheet is only about 2% smaller than it was at the peak of QE. And I think most people in financial markets who are quite attuned to the QE/QT debate, they're of the view that the balance sheet might get smaller, but not a lot smaller. And when things turn bad, the balance sheet will grow orders of magnitude again. And so as I think about the balance sheet, I'm open-minded to an aggressive central bank on both interest rates and balance sheet expansion. But as a matter of risk management and as a political economy matter, as Vince said, the more the Fed has a permanent imprimatur, both on the economy and the financial markets, the more it's likely to find itself in harm's way over the course of the period ahead.
And with that, we are out of time. We have a break now. The next session starts at 1:15 with Thomas Sargent. Thank you, Kevin Warsh, George Selgan, Vincent Reinhardt, and Patricia Zobel. And I'll be back at 1:15. Thanks.
Hello, good afternoon. I'm Norbert Michel. It's my privilege to introduce Thomas Sargent. He's an economist that really does not need much of an introduction. He's done an enormous amount of work in macro, dealing with, among other things, rational expectations and inflation. And of course, he won a Nobel Prize in 2011. If you have not read his commencement speech that he gave to Berkeley students in 2007, you should. It's only about 300 words, and it's a bulleted list of the valuable lessons that economics can teach us. And I'm not going to give you any examples because it's only 12 bullets. So you should check that one out. If that's dissatisfying and you still want a very succinct summary of his work, you should check out the commercial that he did for LA Bank in 2007, where he's asked if he can predict CD rates 2 years out. And his response in full is no. And with that, I will turn it over to Thomas Sargent. Thomas. Okay, we've lost Thomas. He's disconnected. We're going to try to get that right back. One sec. Problem on his end, I think. If or not if, but as we get that back, you can tweet hashtag Cato MonCon. That would be the way to go with those. And again, apologize. Please bear with us. We'll be right back. Oh, no. Okay.
But I have another computer, so. I'm ready.
Okay. I'm telling them and they're going to queue us up and then, all right.
Okay, and I really apologize, but what?
It's okay. Sorry about that, folks. We had a glitch. Turns out Thomas's computer crashed at the exact wrong moment. But when you're a Nobel laureate, you often have at least two computers. So now we will turn it over to Thomas Sargent.
Okay, so I should try to share my screen, right? And I really apologize for this. Okay, so here. So let's see. I don't know what you can see. Can you see that now? Can you see my screen, Norbert?
It's not all there, but I can see everything. I can see it, but I can't read the whole thing.
I don't know what's happening. Something's bad with the, okay, so. Let me just, this is terrible.
It's okay, Thomas. I think just go ahead and roll with it.
Well, if you can't see my screen, I need people to see my screen. So you can't see what it says here.
I can not the entire picture. No, I know what it's supposed to say too, and it's not all there. So
Okay, why don't you give me 3 more minutes to see if I can start this other computer? If you can, I do that?
I suppose we could.
Yeah. Let's just do this.
Okay, let's do that. Or
why don't you stay and I'm going to try see if I can get some other software to work on this. Because
okay.
Let's just try.
Yeah, we'll be right back, folks. I'm sorry. Okay, folks. Again, we apologize for the technical problem, but we are now back. And I will turn it over to Thomas Sargent right now.
Okay, I apologize for the technical problems. Okay, so what I'm going to talk about is the plural of American inflations. And I'm going to talk about North and South. So here goes. So my theme is going to be well stated by this quote from John Taylor in the late 90s. Changing economic theories and opinions about inflation are the ultimate cause of the changes in actual inflation. And I'm going to give you two variations on that theme. So my theme is there's going to be theories in play, better and worse, but not perfect. There's going to be learning by the public and by policymakers. There's going to be expectations. You could think of rational as a benchmark, but there's going to be adaptive, 1990s adaptive. In the tradition of a couple of current Fed presidents, Jim Bullard of St. Louis and John Williams of New York, who've done extensive work in this tradition. And then there's going to be temptations, almost a biblical theme of temptations. And the temptations that I'm going to talk about is different temptations in the North and the South. In the North, the stories about the conquest of inflation are going to all be about temptations to exploit a perceived Phillips curve. In the South, it's going to be a temptation to use the printing press to finance government deficits. And I'm not going to put these together until perhaps the very end. So my North American story is based on this, is mostly based on this Princeton book I wrote in 1999 about the conquest of American inflation. But John Taylor and Brad DeLong and Romer, they had related versions of my story, very close to the story. We're all on the same page. So what is that? This is all about the sweep up of inflation in the 60s and 70s, and then its conquest by Volcker and Greenspan and her followers. So here's what the story is going to be. Milton Friedman is going to be, you're going to see he pervades this whole story. It's going to be about inferring an incomplete model of the Phillips curve. It's about monetary policy authorities and taking monetary policy actions based on a model, and an incomplete model. It's a non-expectational Phillips curve that they had in mind. It's going to be there then experiencing the consequences of those policy decisions taken with that particular incomplete model. And then it's about using the data that came in when they got those consequences to refine the original Phillips curve after detecting a missing variable. And the missing variable is expected inflation. The same variable that Milton Friedman in 1967 said ought to be in the Phillips curve, but wasn't. There's a very prescient remark, because that's a story. So the components, the theoretical components in the background, there's going to be labor supply and labor demand. There's going to be a family of Phillips curves that are indexed by expected rates of inflation. There's going to be expectations, mostly adaptive, in 1990s adaptive. There's going to be learning, and it's all about the government. This is in the Taylor, DeLong, Romer, and my story. It's all about the government learning about a non-expectational or expectational Phillips curve, coming to grips with trade-offs, if any. And then there's going to be one other force. Okay, so here's a picture. we teach both the undergraduates and graduates still. So the idea of the Friedman idea was that in truth, there exists a family of Phillips curves. There exists Phillips curves, but there's a family of them. And they're indexed by the public's expected rate of inflation. So I've drawn one for expected inflation is low. And so here's the Phillips curve. Here, on this axis is unemployment. Here's inflation. U is U star for Friedman's natural rate. So if you had low anchored expected inflation, you had that Phillips curve. The data would be scattered about that. If you had high expected inflation, it would be like that. That's kind of Friedman's story. So this, just to elaborate on this, if you have anchored expected inflation, if it anchors expected inflation, then I have expected inflation anchored at 0.02. You know where I got that number. The data would come in scattered like this, and essentially, the gap between expected and unexpected inflation is it's a surprise inflation, and that surprise inflation generates this gap. That's kind of the Friedman, Phelps, Lucas expectational Phillips curve. But now the data look like that, so there seems to be some trade-off, but it's not an exploitable trade-off, and it's only that trade-off if you don't try to exploit it. If you tried to exploit it, expectations of inflation will become unanchored, and if they were totally unanchored, so expected inflation is actually equal to actual inflation, apart from some shocks on average, approximately, then the data would be scattered like this, and it would be a steep Phillips curve. Kind of if I showed you some data, I have some beautiful actual data where, over time, this Phillips curve actually did drift up and end up, oh my goodness, it ended up, yeah, sorry. Okay, sorry. It ended up looking like this. So what's the message of this is all about, the story is all about the natural rate and surprise inflation. And it's all about, the lesson is about the different consequences of anticipated by the public and unanticipated or surprise inflation. With anticipated inflation, there's a vertical Phillips curve and there's no apparent trade-off. With surprise inflation, there's a flat Phillips curve. There's an apparent trade-off, but it's not exploitable. And so this story about the conquest of U.S. inflation is all about, it's all about the Fed and the policymakers kind of groping their way toward a correct view of the Phillips curve that teaches them it's not exploitable, and then bringing inflation down the way Volcker and with some pain, with the way Volcker and Greenspan did. There's variations on this story that bring in a bigger or smaller role for rational expectations, but the basic forces are there. So now I want to go to South American inflation, and I'm doing things in what I regard as the Chicago, a Friedman Chicago tradition. I'm going to build stripped down. The work I'm talking about, they're stripped down models that focus on just a few forces at a time and don't put in everything. So in this model, what's going on in South America, this is influenced by Friedman and Kagan's work about the monetary dynamics of big inflations. And they had a couple key elements. One is there's a demand for real balances. M over P is an inverse function of the public's expected rate of inflation. Why? Well, if expected inflation is high, people who hold real balances have an incentive to economize on them. But the level of real balances is the base of an inflation tax. So there's a demand function for real balances. That's one component of this body of theory I'm going to talk about. There's a government budget constraint. And the key thing is the government finances a deficit by printing money, uses the printing press. It gives rise to that temptation. So there's inflation tax revenues. Those are real revenues. But now, because of this inverse demand function for money, there's a Laffer curve. And there's a low tax rate and a high tax rate that generate the same revenue. We'll see that. And then the last thing is there's theories of expectations, and partly because of what some earlier speakers talked about, I'm going to use adaptive because this world is going to be sufficiently complicated that that it's hard for people to figure out everything immediately, and we're going to put them in this environment. So that's what goes on. Okay, so with that, okay. Okay, so good. So what's going to be in play here? It's a term from Stan Fisher. We have this Laffer curve. There's going to be a slippery side of the Laffer curve. I'll show you what that means. And this theory is going to be a fiscal theory of inflation. Fiscal in a sense that Friedman bought it a long time ago. And so we're going to have adaptive expectations in the 1990s version. And the reason I'm going to use adaptive expectations, even though I admire rational expectations, is this is going to support a fiscal theory of inflation. And what I mean by a fiscal theory of inflation now is this simply the idea that bigger sustained deficits, if you run sustained government deficits and you print money to finance them, that's going to bring bigger inflation. That's going to be bigger inflation. And I think of this as the old time religion. Okay. So here's kind of what's the key graph. If I put so this graph's going to underlie the Chicago Friedman Laffer curve, Stan Fisher, slippery side of the Laffer curve, fiscal theory of inflation. So what's here? I put a pi TE dot. That's the rate of change of the public's expectation of inflation. There should be an E here, and that's a function, this G function, of two things. It's a function of the public's expected rate of inflation, and it's a function of the deficit, which I've just frozen. So I've frozen the deficit. So if you have one level of deficit, persistent deficit that you're printing with money, there's this curve that tells you the way expected inflation is moving on average if people are using sophisticated adaptive expectation. Essentially, they're just running regressions based on the data that comes in. And these arrows, okay, so here's 0. These arrows are pointing, they're telling you which way expected inflation is going. And so if you notice this graph, there's two zeros. And those are steady state, roughly average tax rates that these dynamics imply. There's this one, which is the low, that's expected inflation tax rate. And there's this one, the high inflation tax rate. So just like, Laffer pointed out in a different context, there's two tax rates that finance the same government deficit with printing money. And this one is stable and this one's unstable. Okay. And I like this one. And fortunately, this adaptive expectations leads to this. And once you get here, this is very close to a rational expectations equilibrium. I'll just say that. Okay, so here's this slide is everything about the fiscal theory of inflation. Okay, so what is, if you increase D, what does this curve look like? What happens to this curve? Well, if you do a little math, and the math just involves take a real demand function for real balances of the kind I said, put in the government budget constraint with printing money, and do about 10 lines of algebra. And you'll find that this curve now looks like this. So if you increase the government, larger D shifts this curve up, and it causes this low, this stable inflation tax rate to rise. And you know, that embodies the fiscal theory of inflation. And this one is the opposite. It's kind of crazy. So that's one reason we like adaptive. That's one reason like Bullard and Williams like adaptive expectations. This isn't the only time when this becomes a reasonable one. Okay, so now I'm going to lead up to like we're going to put this to work to study Latin American inflation. And this is some work. So I showed you that book I wrote, Conquest of American Inflation. I should have titled it Conquest of North American Inflation. So with some pals, we wrote a paper called The Conquest of South American Inflation. And we're using this type of model. So here's kind of the picture. I'm just going to draw this with 1D. Okay, so there's my original picture. And now I've kind of colored this. This is the fiscal theory of inflation stable region. And as long as we kind of the shocks to the system aren't too big, we're driving toward this point. And deficits are why do we get high inflation? It's because there's big deficits. But then there can be a shocks which occasionally pushes expected inflation kind of by shocks into this region. Well, if we ever got into this region, expected inflation just takes off due to the dynamics of learning itself, divorced from the fundamental causes of inflation. This when you get into this region, this is Stan Fisher's slippery side, and you know he was interested in this because he was interested in Latin America. Inflation takes off. Okay, so that's going to lead to an approach to studying South American inflations. So we have this dynamic Laffer curves. There's going to be what I'm going to call a fiscal reform is lower the deficit that has to be financed by the Fed or the central bank. Well, fiscal reforms lower the inflation tax rate. They expand this stable region, and they contract this nasty slippery side region. So, you know, fiscal reforms are good, quote unquote, if you like low inflation on all three counts. Okay, so my friends, Noah and Tao, this is a Fed project, Atlanta Fed project, the conquest of South American inflation. So here's what we did in this paper. We used a statistical model of the type that I just described, you know, with putting some shocks carefully in and data. And then we use it to infer what happened in a bunch of South American countries from their histories of inflation. And we ask what caused inflations to ignite and then to stop. And there could be several things. There could be fundamentals, government deficits financed by inflation tax. That's what we call fundamentals. But there could be some inflations that occur just because of destabilizing expectations and shocks that occasionally divorce inflation from fundamentals. That can happen. And the way it happens is because of this these dynamics I showed you for expected inflation. So that can happen, and they push you into this escape region where you're heading north. And then there's reforms. There's a couple kinds of reforms, and you know, South American history, recent last centuries, pockmarked with reforms that are temporary. So they're fundamental reforms. They reduce the deficit, and there's cosmetic reforms that are trying to reset expectations. How you do that? we could have a conference about that. How do you reset expectations if you don't affect fundamentals? Okay, so well, we did that in used some statistics, mostly Tau and Noah. So we used the model and data together. You know, the data never speak by themselves. You're always using some kind of model. So what we find is for Peru, there were cosmetic reforms, were stabilizing inflation temporarily, and then there were eventual fundamental reforms. We detected those. In Bolivia, fundamental changes, government deficits were the culprit, both for the causes and the cures. Argentina and Brazil. So anyway, so if you read the paper, we talk, you know, we use the model on all of these. And then in Chile, shock volatilities matter. And so, you know, some people in the last session were talking about shock volatilities in a really interesting way, that they had increased. Well, something's going on in Chile anyway. So, okay, so I'm gonna wrap up soon. So you'll kind of notice the following: the common sources of what I'm talking about are Milton Friedman. If we're going to do a history of thought, both types of models are intimately connected with work of Milton Friedman and his teachers and students, and some of it's connected with Hayek, because these adaptive models have an evolutionary component that's really important. Milton Friedman did other things about the connection between adaptive and rational. The most sophisticated work about that, and some of it's by Bullard and Williams, by the way, these Fed presidents, was the first work on that was put down by Friedman. I'll just say that. Okay, finally, I'm going to credit or blame Friedman on this. I've used separate models for North and South, and you'll notice that. And well, what about general equilibrium theory? Shouldn't everything be connected? So I think of Milton Friedman as both a really good general equilibrium theorist and a partial equilibrium theorist. And he, one thing that marked his work was a flair and a good sense for which pieces of a general equilibrium system should you isolate and which pieces should you put in the background. And you notice I've tried to copy that with a different story for North and South for particular purposes. But now I kind of want to question that.
And Thomas, this is Norbert again. If we can, just trying to wrap up over the next 10 minutes, and then just to be mindful of the next panel, we'll probably just skip audience questions.
Okay, good.
We can move into the next one, but.
Okay. So I'll have, so you and I can talk. So I'm almost ready to wrap up. So now I just want to say, what about U.S. inflation today? So remember, I just said, I've kind of shamelessly appealed to Milton Friedman for this two-part strategy, North and South, and separating. And now I want to ask, is that a good idea? So you know, Phillips curve in the North, demand function for money, different temptations in the North and South. Okay, so oops. Okay, so what about the U.S. today? So I want to just close by reconsidering this, what I call the Friedman isolation strategy. So versus a more general equilibrium approach. So which forces are in play in the United States today? Just the North forces learning not to exploit, or how to cope with the Phillips curve as the data on inflation and unemployment come in, and as the curve seems to shift on us, for maybe partly because of things that the authorities are doing, or the South using an inflation tax to finance the government deficit, or are both going on in the United States today? Heaven forbid. So this is, I'm just going to point out some thinking that I've done with my friend George Hall. We wrote this paper in the Proceedings of the National Academy of Sciences in the spring, published in the spring. And this is about 3 world wars and monetary and fiscal consequences. And the idea here is we detect patterns that are similar in US participation in 3 what we call world wars, and take some liberty. World War I, World War II, and the war in COVID, both of which are associated with big shocks to the labor markets, either in the form of draft or in forms of shutdowns, and big surges in government expenditures. That's kind of a common force. So I'll show you some pictures about consequences. What this is I'm going to show you some pictures and then stop. Here's the log of the price level from the start of 3 wars. So the way this graph does is we took the 3 wars and we had when the war started, and we plot the log. This is the log of the price level. So you see World War I, see World War II. You can see the price controls in World War II. So you see what happened to the price level after the war. The log of the price level. Look where COVID is. COVID's the blue line. And every month, George and I add an observation, and then for better or worse, it's just creeping along and following that same pattern. Okay, so now here's the next thing, and this is going to be sorry about this. I need one more. A North Star. Okay, there. Here's how are creditors of the U.S. government doing? So what these are real, and how do they do in the previous wars, big world wars? So the cumulative real return on holding a portfolio of U.S. government debt from the starts of 3 wars, well, you can see is U.S. creditors in real terms, they did badly. They got negative. They got in net terms, they got gross returns, which were far less than 1. And what you'll see is in the war on COVID, this blue line is following the experience of our 2 wars. And now I'll show you one other. I'll show you my final graph. Okay, what this is the U.S. debt GDP ratio in the 20th century up to very recently. And so what you'll see is after World War I, there was a rundown in debt that was paid for in a certain way. After World War II, it was paid down, and inflation and bad returns to government bondholders was part of the source of that rundown. And here's the war on COVID. And if you'll notice, in the last more than a year, the debt GDP ratio, real debt GDP ratio has been declining. You could read in our paper what these blue lines, these have to do with repo and paying interest on reserves, but the debt GDP ratio has been declining. And why has that been declining? Well, the US has been imposing an inflation tax, not only on holders of currency, but on holders of US government interest-bearing securities. And that's contributed to this. And now it's kind of a criticism of the whole structure of this talk. I separated it into this in North and South. And the question to ask is are some of these experiences, I hope it's not true. I hope this last 3 minutes is impertinent. But is it true that some of these considerations are coming into play? And by the way, this inflation tax, it doesn't just redistribute between government creditors and the government. It contributes between private debtors and creditors. I'm done, Norbert.
Okay, thank you, Thomas. So again, we're gonna forego questions for our next panel, which comes up at 2:15. Thank you very much, and we will be back.
Okay, I apologize.
It's okay.
Okay, bye.
Welcome, 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 everyone, to the last panel of the day, the future of money in a fintech world. We have some amazing panelists. I already know that they are going to give us a interesting and provocative vision of the future of digital currency in central banks, the future of digital currencies versus other existing alternate currencies like Bitcoin and Ethereum. So I am going to give us the briefest of introductions so we can go right into their comments. One reminder, if you have questions, those of you in the audience, you can send them in via Cato's webpage. You can put them on Twitter, hashtag CatoMonCon. You can put them on Facebook and through the chat box on Slido. So without further ado, we are going to start today with Dr. Eswar Prasad Tolani, Senior Professor of Trade Policy at Cornell, and also salient to this column, author of The Future of Money, How the Digital Revolution is Transforming Currencies and Finance. We're going to follow with Dr. David Musto of Wharton, Dr. Megan Green, Global Chief Economist of the Kroll Institute and Senior Fellow at the Watson Institute for International and Public Affairs at Brown, and Dr. Lawrence White at George Mason. So let's start with you, Dr. Prasad. You wrote the book on this. I know it's a challenge, but please give us the most immediately salient portion of it, given all that has happened since you published it.
Thank you, Christopher, for that kind introduction. And the Cato Monetary Conference has become one of the leading fixtures of the fall conference circuit. So this is really a privilege. And it's also a privilege to be talking about this at a time when I believe we are entering a new era of money, but not quite in the form that might one have thought about when the Bitcoin revolution started. Now, Bitcoin's appearance on the monetary scene was impeccably timed, coming right after the global financial crisis. In fact, the Bitcoin white paper was published 6 weeks after the Lehman moment, September 15, 2008. And it came in at a time when trust in traditional financial institutions and in central banks and governments was at a real all-time ebb. But what Bitcoin is going to accomplish in the long run really is not so much turn into a major asset in my view, but really set off and catalyze a set of transformations, some of which were already underway, some of which it has pushed further, which are going to make a difference, not just to money, but also to financial markets and institutions, to central banks, and to the international monetary system. Now, there were many developments already underway in the context of fintech platforms being able to provide not just payment services, but even basic financial intermediation without relying on brick and mortar operations and without relying on the traditional tools that commercial banks have had to do two things that they do very well, which is maturity transformation and getting around information asymmetries. If you look at the emerging are taken hold, these are countries from low-income countries like Kenya to middle-income countries like India and China, where digital payments are very fast becoming the norm. But these digital payment platforms are also able to use data in a very effective way in order to provide basic banking products and services. So there was a bit of a revolution underway already. Now, what Bitcoin promised to do was to provide a medium of exchange that did not require the use of a trusted intermediary or central bank money. At some level, this sounds like an incredible proposition, but Bitcoin actually delivered on it. It can actually consummate transactions between parties using just their digital identities and without a trusted intermediary involved. The problem is Bitcoin does not work very well at what it was supposed to function as because it has very volatile value relative to the unit of account, which is still fiat currencies. It doesn't have very fast processing speed or volume. So there are other cryptocurrencies that have stepped in to fill the breach. Stable coins in particular, many of which are backed up by fiat currencies, and then a few that are backed up by other cryptocurrencies, which have already met a sad demise. But fiat currency-backed stable coins are beginning to get traction, in my view, because they are really trying to meet a fundamental need for better payment systems that are more efficient, that everyone has access to,
and that are very low cost. There is an irony here, though. The whole point of Bitcoin was to decentralize the creation and the use of money, but everything about stable coins is centralized. The issuance, the validation, the management of the entire system. And in addition, of course, and the biggest irony of all, stable coins get their stable value by being backed up by stores of fiat currencies. So this is still creating competition, and this is a theme that I think will carry through not just domestically, but on the international dimension as well. The fact that we are entering a new era of competition between privately issued currencies and fiat currencies. Now, as some of the economic historians, the highly distinguished economic historians at this conference know, there has been a long period, even during the previous millennium, when there was intense competition between state or central bank, state-issued currencies and private money. In most countries, the emergence of central banks, which took place in different countries at different times over the last couple of centuries, pretty much decisively settled that competition in favor of fiat currencies. But now I think we are entering a new era of competition. And as economists, certainly we think competition is good. But I think this competition will take a particular form with the new monies, especially the private monies, including stable coins and other mediums of exchange, potentially serving well in that specific function while leaving the store of value function largely resident in fiat currencies. So I think that separation of the functions of money is something we've already begun to see and is likely to gain further traction. Now, into this mix, of course, comes the notion of central bank digital currencies, with every central bank recognizing that if it wants to keep the money that it issues still relevant at the retail level, it's going to have to be in digital form. Now, there is a deeper question here about whether central bank retail money is really crucial in any way for the functioning of an economy, or even for a central bank to conduct its monetary policy operations. Certainly, a central bank can influence the cost of funds and affect economic activity and inflation without ever issuing retail currency. But there does seem to be a move towards CBDCs with different motivations at play. Bahamas, the country to issue the world's first nationwide CBDC, wants to use its CBDC to broaden financial inclusion, to give everyone in the economy, including mom and pop stores, including low income, low net worth individuals, easy access to a low cost digital payment system without necessarily having a bank account or credit card, for instance. In Sweden, by contrast, the Riksbank seems to view the e-krona or digital krona project as basically creating a backstop to a private payments infrastructure, which might be subject to technological or confidence vulnerabilities. So essentially, an e-krona becomes a public payment option. And then there is China, which of course is sui generis in this as in most other cases. In China, Alipay and WeChat Pay have blanketed the economy with low-cost digital payments, but they control a lot of data, which they were recently with the government. And the government is concerned about these two large players not allowing entry of other players, thereby limiting innovation, limiting competition. But all of these different motivations are converging into a design choice where essentially the central bank provides an infrastructure, essentially a payment system at the back end, provides the CBDCs in the form of digital tokens, but the front end of the payment system, how well these digital tokens are used, how efficiently they are used, is all left to private payment providers, including commercial banks, perhaps telecom companies, and other sorts of payment providers. But there are still risks to a CBDC. One, of course, that if you end up unwittingly or not blocking private sector innovation and payment. And second, there is a real concern about disintermediation of the banking system, with people preferring to hold their money in CBDC digital wallets, even though those might be non-interest bearing relative to interest bearing deposit accounts. I think we are coming up with conceptual and technical design choices that can mitigate these risks, but not really eliminate them. And of course, the one risk that will be very hard to eliminate for anything digital is the notion of a loss of privacy. If we were to move to a world where the only available payment options are a private payment option or a digital central bank currency. Now, on the in terms of monetary policy, there are going to be some complications that arise, but this comes also from the fundamental transformation that is taking place in financial markets. I spoke earlier about fintech platforms undertaking financial intermediation functions. There are now a lot of new players who are providing competition to commercial banks. You could even think of a stablecoin issuer as, in some sense, a narrow bank, basically taking deposits and providing fully collateralized loans. So in a sense, we are moving to a world where commercial banks may face a large number of threats, because both in terms of domestic payments and international payments, and in terms of the basic financial intermediation functions, they're going to have a lot more competition. This is going to complicate the conduct of monetary policy, because the one thing we know is that commercial banks are still very important in terms of the creation of money in modern economies. Most money, after all, is created by commercial banks rather than the central bank. So if commercial banks start playing a smaller role, how exactly monetary policy work, how credit creation will work, remains to be seen. There is some evidence, in fact, that the shadow banking system actually tends to be pro-cyclical, to creating credit when the central bank is trying to reduce credit. What about the international dimension? We've heard about China moving forward aggressively with the digital yuan, while the US seems to be a bit of a slacker with the digital dollar. But of course, with Fed now soon improving payments in the US, we hope, the case for a digital dollar might be even more weakened. So is China going to get a head start? Here too, I think my initial theme of the bifurcation of the roles of money is going to be important. Certainly, one can imagine that in combination with the cross-border interbank payment system that China has set up, which actually I think is going to be the game changer, because it can communicate directly with other countries' payment systems, even act as a messaging system that can bypass SWIFT. So if you take CIPS, or the cross-border interbank payment system, and the digital yuan in combination, one can well see the yuan getting a little more traction in parts of the world where China has a significant economic and or political footprint. It's going to mean that China's currency is going to be used more as a payment currency. But is it going to change the renminbi's role as a reserve currency? There I hold to the view that for a store of value that domestic and foreign investors trust, you need a lot more than economic size and easy availability of a currency. You need a strong institutional framework behind that currency, an independent central bank, an institutionalized system of checks and balances, the rule of law, none of which China has shown any indication of moving towards. So I think even on the international dimension, we're going to move towards a world where there could be this bifurcation of the roles of currencies. There is one group of countries for which there are going to be benefits from reduced frictions in international payments, but also a lot of potential risks. And these are the emerging market economies, and especially small open economies, because for these countries, if you think about the possibility of digital yuan or a digital dollar being easily available, or even a stable coin issued by a major corporation such as Amazon, or perhaps one day Meta, if it revives its project for a stable coin, those alternatives could be much more heavy, or the domestic central bank. So those currencies, in my view, face a real existential threat. And of course, the reduced frictions in international payments is going to be good for exporters and importers, economic migrants sending remittances back to their home countries, small entrepreneurs looking for capital, not just in their home country, but abroad, but also means a lot more capital flow volatility. So it's going to be an interesting time in terms of the evolution of money, with, I think, certain types of money potentially becoming even more powerful in their roles as stores of value, while the medium of exchange function is where there is going to be a lot more competition. And the one thing for certain is that we are in for a very exciting time in terms of the world of money, finance, as well as international finance.
Thank you so much. And I would like to move on now to Dr. Musto, if you are available.
Hi, great to be here. All right. Okay. Well, let me dive in then. And
glad you.
So, Chris, sorry, good.
You're here. Please please take it away. I know you have some comments that could follow that.
Well, I put together a few bullet points I'd like to cover.
Oh yeah, go ahead.
Cover anything that Eswar just talked about. Maybe just like drill down on a couple things. But just a few bullet points I wanted to go over, and then of course, hopefully we can chat about these afterwards. So just a little background. So I'm the faculty director of the Stevens Center here at Wharton, the Stevens Center for Innovation and Finance, which is our Fintech center here at Wharton. And in the context of that, I interact a lot with the students here who are interested in fintech, in crypto and blockchain topics, and the whole range of fintech topics. And we also do a lot of outreach to the neighborhood, to high school students and so on. Also curious about this, and also we interact a lot with a lot of the big players in the crypto space. And so the main thing I want to focus on is just a few sort of interesting thoughts that I have picked up in my interactions with the industry about mostly on cryptocurrencies here. I don't have too much to say about. I'm not going to say too much about CBDCs, since that seems to be covered pretty well by the other participants. So, okay. So, of course, the interesting thing from the point of view of our students is that if you think about all the wealth that's been created over their lifetimes, the large fortunes that have been made, so much of it is network effects. How we joined Facebook instead of, back in the day, MySpace, because everyone else is on Facebook, and we go to Amazon and Google and all these, we've just mentioned Alibaba, all these different platforms we go to because other people are there, and just to get this critical mass, and you get network effects and everything explodes and the tremendous fortunes are made. And we look forward to the future of money and future monetary systems. Cryptocurrencies offer the possibility of not just, building apps that thrive on the new monetary system, but actually building the monetary system itself and capturing some of the value of the network effects that it creates through your ownership, right? So, so when you think about the trading cryptocurrencies, it's this is buying a piece of the future monetary system, and I think it's worth pausing for a moment. People talk about Bitcoin in particular. So much of the focus is on the price of Bitcoin, which of course is way off now. It's 2/3 off of where it was at its peak, though I'm guessing everyone in this conference would love to get in a time machine and spend their lunch money 10 years ago on Bitcoin. We'd still be pretty well off. But Bitcoin, has been very volatile, not just the recent drop, but the gigantic run up and several run ups it's made over time. And as Eswar was just alluding to, this makes it clear, the volatility makes it clear that it's nowhere near being a reliable store of value or unit of account. And if you can't be a store of value or unit of account, well, those are two of the fundamental jobs of a currency. So it's not much of a currency. It's very much a speculative asset. And of course, you have to ask yourself, if it ever did become a reliable store of value or unit of account, you'd have to expect all the speculators who are now so long in Bitcoin to be getting out of it, since these are not the sort of people who would just hold boring dollars, so they're not going to hold boring Bitcoin either. So if it ever did become a unit of account, they'd be getting out of it. And you have to wonder, how stable would the price of Bitcoin be if the people who are now holding it started to get out of it? So I think that's sort of a brain teaser for another day. How do we move to an equilibrium where today's speculators offload their Bitcoin to non-speculators at something like its current price? But for today's purposes, so imagine the future monetary system, and we're trying to imagine the future monetary system and the role of cryptocurrencies in it. I think it may be useful to think of Bitcoin not as the currency we'll be pricing and saving in, but instead as one big player in the space put it to me, as the bars of gold in the basement of the New York Fed. Think of a Bitcoin as a bar of gold in the basement of the New York Fed, right? With these bars of gold, the Fed can execute large transactions very securely, but also slowly and laboriously. And you can think of Bitcoin transactions on the blockchain in roughly the same way. The Bitcoin blockchain, it's slow, it doesn't accommodate a lot of transactions, and the energy demands are huge, but it gives us the security that lugging those gold bars between the cubbies under the Fed gives us. And arguably it gives us even more security than the Fed can give. And a monetary system that relies on those slow and expensive, but big and secure transactions in gold doesn't live or die by the price of gold, right? It serves a function underneath whether the price goes up or down doesn't necessarily play a big role. And so that's a good description of the payment systems that are being built on top of Bitcoin. They use Bitcoin holdings to move value between payers and recipients, and they rely on the Bitcoin blockchain for security, but they don't rely on the day-to-day stability of the price of Bitcoin. They do need people to hold Bitcoin, of course, though, and so you need that to hold Bitcoin and to provide it to this payment system. So that's one way I think to think about what's the role of Bitcoin and some of the other cryptocurrencies in the future. We call them currencies, but we don't have to think of them as playing the role of a currency in the future monetary system. And by the way, the energy demands of Bitcoin were in the news again today. So the Biden administration is raising concerns about, how much energy is being used, and people are hoping, of course, that this upcoming merge with Ethereum, where the hope is to go forward with a proof of stake system as opposed to the proof of work that uses all the energy. Maybe that will take off and the energy demands will be reduced. So maybe that'll happen. And if that happens, of course, that would relieve a lot of tensions. But if the energy demands of proof of work are here to stay, let me just offer something that I hear a lot from people in the industry, and you can take it where you want. But the point is that this might not be as hard on the rest of society as it first appears. And the point that has been made to me by a couple players in this industry is that in the future, the mining operations where you're doing this proof of work could ultimately be owned by the electricity suppliers themselves and run in a way that reduces their externalities. So imagine, and this is an example I think of, imagine a utility in the panhandle of Texas, which is close to a lot of wind there in the panhandle of Texas, and a lot of windmills, but it's very far from major cities and other customers. And during the day, the windmills may supply a lot more electricity than is demanded. So the utility could then use that energy to run its miners and then turn that off when supply falls below demand. And the utility can therefore profit from its excess energy, turn this excess energy directly into money. And there really aren't a lot of other ways to turn extra energy into money that you can just turn it on and off, right? You can't have like a smelting operation where you're going to smelt aluminum for a few minutes or hours when the supply is high and then turn it off when it goes lower. Have a production line with workers that work or don't work depending on whether you can move the lines with electricity. But you can just turn on and off mining at the drop of a hat. Turn it on, it's making money. Turn it off, it's not making money. So it's as far as a way to turn excess energy into money, it's about as good as you can get. And that is something like what we see people doing now, but this might ultimately be something that's just right there under the same roof, in the same organization, the same utility. So of course, this all makes a lot less sense the more you can store excess energy and the more you can transmit it long distances. But with the storage and transmission we have now, it can work in a way that means a lot less externality than might first appear. So that's some of what I'm hearing about cryptocurrencies and the future of money. Regarding central bank digital currencies, if you hang around economists, financial economists like I do, and follow the papers people are writing, we were just talking about the possibility of disintermediation where I could put my money in a bank account, I could put it in CBDC, or why not put it in CBDC instead? Well, that might be true in a general sense, but what people really worry about are the panic situations where you have rapid disintermediation all of a sudden in a crisis out of the commercial banking system and into CBDC. That's the main thing that when this comes up in a room full of financial economists that people start talking about. And there are various patches that one could put on that. Maybe we'll be talking about those patches coming up, so I'm not going to go into it now. So the main thing I wonder about, and then maybe, and I think I'm going to leave this to the next speaker, is when we think about the potential costs of a central bank digital currency, the potential sort of fragility risk I'm talking about there, maybe some of the other things that privacy concerns and so on, versus the benefits, the lower cost of remittances and the faster settlement and all of that, maybe easier fiscal policy. And we're trying to strike this balance. Are we going to pick the balance that's best for us? Are we going to be pushed into this because we don't want China to get ahead of us and for us to lose what we gain from being the world's go-to currency, right? So can we, are we going to be pushed into this or can we decide for ourselves whether this is the right move? So let me leave it at that and hand off to the next speaker.
Thank you very much, Dr. Musto. And I think addressing both your comments and Dr. Prasad's, Dr. Green, I would love to hear your thoughts on, central bank digital currencies and, of course, how China is unique. It feels like this is one of the most important issues in this entire topic. For the next 10 to 20 years. So please take it away.
Yeah, thanks. And thanks so much to Cato for inviting me to speak. This truly is one of the best Econodork Fests of the year. So it's a real pleasure to be here. And as you mentioned, I'm going to focus my comments on central bank digital currencies, which of course you never heard anything about 10 years ago. And now all of a sudden it's everywhere. So I'm going to talk about some of the motivations for establishing a central bank digital currency. And then I'm also going to talk about some of the solutions that CBDCs are actually meant to address and how likely they are to address them. So to start off with the motivations, why we're all of a sudden hearing about central bank digital currencies constantly. There are four main motivations. One really is the rise of crypto and Fintech. So all of a sudden, all these payments, deposits, lending threaten to leave the banking system. And I think that's really scared central bankers. They're going into relatively unsupervised networks. And so central bankers are looking to keep those payments in particular within a system they can control and see. Secondly, and related to this, remember Facebook announced Libra/Diem. And to use a technical term, I think that scared the bejesus out of central bankers, right? All of a sudden you had a tech firm with really deep pockets saying that they were going to establish this kind of international currency. It's gone nowhere, but I really do think that ignited this push for central bank digital currencies. A third one is much more recent, and that's the pandemic. A number of central banks have cited that they've accelerated their research for central bank digital currencies because of the pandemic, because they realized all of a sudden that they needed to get money to individuals and quickly. And so central bank digital currencies could be one way to do that. And we've needed to do it once, but we know we're probably going to need to do it more going forward. And then finally, I think a big push for CBDCs has come from China. So from the ECNY, the digital yuan. And now, of course, these are all motivations for Western central banks, I'd say. China has its own motivations for establishing a central bank digital currency. And they go entirely against our motivations, actually. So one motivation is to internationalize the yuan. And Dr. Prasad had said he thought actually there could be some success in at least gaining a bit more traction for the yuan if there were a central bank digital currency. I think that's right. I don't buy the arguments, though, that the renminbi could challenge the dollar as global reserve currency off the back of this. I don't think that's right, but I do think that China's looking to internationalize its currency a little bit more. It's also looking to set the standards for central bank digital currencies. It is, as the first big economy to set one up. There's been a pilot program for 7 years now. It's being used in over 10 cities. China gets to sort of establish some of the governance and some of the standards for everybody else's, so that's important. Also, China can embed limits directly in the currency. So that means that it can actually target its capital controls and make them much more precise, which China has an interest in doing. It could actually allow China to open up other parts of its capital account a little bit more than it already is, if it can really crack down on exactly what it's looking to crack down on. There's a privacy issue that we in the West are really concerned about. China's viewing this as a feature, not a bug. They get much more data on people if there's a central bank digital currency, and that's a bonus. And then most recently and importantly, I think, establishing a central bank digital currency in China is a way to circumvent sanctions. So China's watched as the U.S. has weaponized, U.S. and its allies have weaponized finance against Russia. And to be clear, even with the central bank digital currency, it couldn't totally circumvent sanctions. The US can always block anyone from access to clearing, which would make it really difficult if you have to do anything in dollars. And so the US does have some recourse on that, but it would make sanctions much harder to go ahead and enforce. So I think that's another one of China's motivations as well. And then, of course, in reaction to China's pilot program, I think that the West has really taken on this call that we all need to establish central bank digital currencies. There's a bit of FOMO out there, I think, with central bank digital currencies. And I have to say, I like to think of myself as a pretty early adopter. I'm pretty open-minded, but I'm a little bit skeptical of central bank digital currencies. I tend to think of them a bit like Swiss Army knives. When you're out in the woods and you need a tool that can do a lot of different things, Swiss Army knives are fantastic. When you're in your kitchen, I don't think anyone's reaching for their Swiss Army knife for the corkscrew function so they can open a bottle of wine, right? You'd actually rather use a normal corkscrew. And I think that relates to central bank digital currencies insofar as they're meant to solve a whole host of problems. And I'm going to talk about 6 of them specifically with one tool, but actually it's not clear that they're the best tool for any one of those. And so I'm a little bit skeptical. That being said, I think they're absolutely inevitable and they're coming. And so we need to be thoughtful about their design. One of the problems or one of the goals that central bank digital currencies are meant to achieve is to improve on cash. So issuing cash is actually pretty expensive. You then also have to pay for handling, safeguarding, counterfeit prevention. The Fed actually in 2021 budgeted $1 billion to reimburse the Bureau of Engraving and Printing for printing its currency. So it's pretty expensive. There are all kinds of money laundering implications. If you lose it, you can't get it back. So there are some ways that we could improve on cash by establishing a central bank digital currency. And I should highlight, I'm only talking about retail central bank digital currencies because I think wholesale central bank digital currencies are a solution without a problem, actually. So specifically talking about, you and me being able to have an account where we can use central bank digital currencies to buy a cup of coffee. So there are ways that a central bank digital currency could improve on cash. It could be a lot cheaper in particular. But that being said, cash isn't going to disappear. So we'll still have cash in the system, I think, even if we launch a central bank digital currency. It will probably decline, and we're already seeing cash decline even without central bank digital currencies. So that could defray some of the costs, but it will still exist. So some of those costs will persist as well. A second goal for central bank digital currencies is to boost financial inclusion. So there are a lot of unbanked people in the world. The idea is that we can actually make banking sort of cheaper and more inclusive. In theory, that works. In practice, it might not, actually. If you establish a central bank digital currency, then people have a choice between, in theory, between whether to keep their deposits in a bank or with the central bank. The central bank's obviously much safer. And so some of those deposits are going to leave banks and go to the central bank. That means that banks, if they lose their deposits, even if it's just some of their deposits, they're going to be able to lend less. And they'll probably have to jack up their fees to make up for lost revenues in terms of their lending in the simplest model. And so actually you could end up making banking a whole lot more expensive. So while people could get access to central bank digital currencies, it could make banking less attractive. And there are services that banks might provide that a central bank might not be willing to, credit allocation, for example, that people might want. So it may not actually boost financial inclusion. Also in the US, about a quarter of those who are unbanked said that the biggest reason they were unbanked was that they don't trust banks and they want privacy. I'm not sure that regular people are really discerning that much between banks and a central bank. I'm also not sure that regular people are discerning between a central bank and the government. So I think people don't want a central bank to have full viewing of all of their transactions over the course of a year, while in China that's desired by the central bank. In the US and the West, that's a much more thorny topic. So I think privacy is a huge concern as well. So even if you establish a central bank digital currency, people might say, no way, I don't want the government viewing all my transactions. So it's not clear that central bank digital currencies could actually solve that one. There is a hope that central bank digital currencies can improve payments. So for domestic payments, I would say we need to do that anyhow, particularly in the US, but also in other countries. FedNow is in theory launching next year, so that should improve domestic payments, make them much faster, more instantaneous. When it comes to cross-border payments, which I think there's much more room to improve on, I think central bank digital currencies are going to have a hard time taking care of that effectively. If you establish cross-border payments between two countries, then those two countries have to establish a digital corridor, and they have to agree on the architecture and the governance of that corridor. Now, that's pretty complicated just for two economies, but if you consider there are 200 plus currencies in the world, to really see central bank digital currencies be adopted broadly for cross-border payments, it's implausible that many deals can be done. Even in the face of a war, we're seeing divisions between countries. So, and I'm referring to the Russian invasion of Ukraine, you can imagine that it would be difficult to get so many countries to strike that kind of deal to set up those digital corridors. So I think it's unlikely that central bank digital currencies will solve that problem too. There is an argument that actually a central bank digital currency could improve the transmission of monetary policy. And there, the specific focus is the ability to implement negative rates. So if everybody's got central bank digital currencies, then central banks can go ahead and impose negative rates across the board. This used to be one of the most compelling arguments for central bank digital currencies, I think. In an environment where we're facing high inflation, that's obviously a much smaller concern. No one's looking to impose negative interest rates. No central bank is. Now, whether inflation is structurally higher or not has certainly been the topic of discussion over the course of this conference, and certainly for months amongst economists. I think the jury's still out when the dust settles what the economy and what inflation will look like. But I think having the ability to impose negative rates might be less compelling now than it once was. And again, you'll still have cash in the system, so that could make negative rates a little bit less influential. There is an argument that I think Dr. Musto mentioned, Dr. Prasad mentioned, about how central bank digital currencies could actually improve competitiveness or competition rather across the banking sector. So for example, if there's an interest paid on a central bank digital currency, then banks are going to be forced to follow suit. That's certainly possible. And here design, I think, is really key, because that is one option, but actually central bank digital currencies could also completely decimate the banking sector. So if individuals hold accounts directly with the central bank, it would result in the complete disintermediation of the financial system. And I think most economists, certainly, and central bankers are looking to avoid that, in part because there are a whole bunch of roles that banks serve that the central bank really doesn't want to pick up. For example, credit allocation. Central banks don't want to choose between who should be a winner and who should be a loser in an economy. And so, that's at the heart of credit allocation. There's also a whole bunch of know your customer, money laundering type stuff, due diligence that central banks don't have the competency to do and would have to spend a lot of money to develop. And so they may well just leave that with banks. That being said, as I mentioned earlier, even if you use banks as a go-between to provide some of the services, some bank deposits will flee and will go into central bank digital currencies. And so bank business models will be undermined to some degree. And that could hurt the banking sector. So you might not actually get improved competition. And finally, just a point that I think Dr. Musto mentioned was financial stability. The idea is that, the central bank is the ultimate backstop. It's the lender of last resort. So if you have a central bank digital currency and your economy goes into a tailspin, people will feel like their money's safe. That could be the case, but we could also see bank runs being accelerated if people have their money in banks and a central bank digital currency. They may be really quick to pull it out of banks, stick it into a central bank digital currency in times of stress. I think that's quite likely. So that one could really go either way. I mentioned at the beginning that I think central bank digital currencies are inevitable. We already have 10 jurisdictions that have launched them. So they're already being used in some places. China, of course, has been a big propeller for other economies trying to develop central bank digital currencies. The ECB is further ahead than the Bank of England and the Fed in developing central bank digital currencies. I think they're absolutely coming in all of these jurisdictions. So I do think that despite my skepticism, we're going to need to develop one. I just think that design will be really crucial in mitigating some of the risks that I've highlighted and addressing some of the goals that central bank digital currencies are supposed to achieve. And so design is absolutely crucial. And I think that the Fed and the Bank of England are laggards, relative laggards, but I also think they're being incredibly careful, and being careful about design, I think, is warranted. I'll leave my comments there.
Thank you very much, Dr. Green. I appreciate the level of detail that you went into and your skepticism. I love the diversity of viewpoints we have on this panel. Dr. White, it's really up to you to kind of take us home here. And I know that you have planned to kind of speak to the competition between central bank digital currencies and other digital currencies at a very high level. So please take it away.
Thank you, Chris. Let me share my screen. So I want to show some slides. Okay. So I want to talk about the choice among monetary standards, which is a kind of level of generality above what technology we use to deliver fiat money. And some of what I'm going to say is drawn from a forthcoming book entitled Better Money, Gold, Fiat, or Bitcoin. Advertisement over. But let's remember where we are right now. We've got record high inflation in the euro, the highest inflation in euro history. And it's really a shame to see, because the euro was supposed to have a constitution that had one goal, which was price stability. And now it's way off track. If we look at the US, we're currently at 8.5% inflation year over year, which is the highest inflation we've had in 40 years. In Great Britain, they're back into double-digit inflation. Again, the highest inflation they've had in 40 years. So the question is whether this is just a blip or whether it may be sustained for as long as it was sustained, as we see in these charts, in the 70s and early 80s, which would be a great burden on the economy and a great tax on the users of the dollar and the pound and other leading fiat currencies. In the rest of the world, in middle income and developing countries that Dr. Prasad mentioned, inflation rates are even worse. here are the worst of the lot. We've got inflation rates above 30% running to triple digits in places like Lebanon and Sudan. So fiat money institutions are doing a terrible job, especially for the people who live in economies where they're more reliant on cash and don't have the inflation hedges as readily available as we have in the West. So what do we do about these kind of rates of inflation? How do we stop them? How do we control growth in the price level? I think it's generally understood now, and Tom Sargent referred to Milton Friedman's work, that we need to control growth in the quantity of money. Because when you add more money to the economy, you dilute the purchasing power of existing units of money. So this is not to say that shocks to velocity and real income can't also affect the price level, but those tend to be small and more or less random over time, whereas growth in the quantity of money can be very large if the central bank wants it to be, and can be very persistent. So we need to control growth in the quantity of money if we want to keep inflation out of double digits, and if we want to keep it to low single digits. How do we control growth in the quantity of money? Well, a popular approach has been, let's persuade the central bank to pay more attention to keeping inflation low. And I'm not against that, but I don't think that's sufficient. I think we've learned that central banks are politically pressured. They have objectives of their own, which have to do with the trade-off between inflation and unemployment. They are pressured by fiscal authorities to accommodate spending. And so we need more than just persuasion. The central bank is already optimizing given all the influences on it. We need institutional constraints. We need to limit central banks' discretion to pursue goals other than stability in the purchasing power of money. Now, where do we get those institutional constraints? Well, this is a long-running discussion in economics, and going back to the last incidence of double-digit inflation, there are basically two approaches that have been discussed. One is imposing some kind of rules on the creation of fiat money, rules on central banks. And the classic article by Kidlett and Prescott talked about the argument for rules rather than discretion as a way of enabling central banks to achieve their inflation targets more effectively. And this is advice directed to policymakers. So I've underlined the word policymakers in the abstract of their article. But it's policymakers who are going to, legislatures who are going to impose constraints on central banks. But there's an alternative approach, which is to provide more competitive discipline on the issuers of money, and so to foster market competition among monetary standards. And the classic work in this approach is Hayek's Denationalization of Money, actually published a year before the Kidlett and Prescott article. And Hayek reflected on why inflation had gotten so bad by asking, why has the quality of money been allowed to deteriorate so badly? And to reflect that, well, in other goods and services, what we rely on to provide us with quality merchandise is competition among producers. You can stop buying a low quality product and switch to a higher quality product. So let's let people choose the best of the monies that are available to them. So the first proposal was let people choose among any fiat money in the world. Don't put barriers to them doing that. Don't stop banks from allowing people to have accounts in foreign currency if the foreign currency is more reliable. But the denationalization referred to Hayek's further proposal that private enterprise could provide stably valued currencies where issuers would promise to provide stable value. And if they didn't, the argument went, the public would abandon them in favor of the issuers who are doing a better job. So that would constrain central banks because they would lose their customers if they didn't match the low inflation rates of the competing suppliers. That was the argument. So what's changed since the 70s? Well, we have more entrants into the market for monetary standards. Bitcoin, which has been mentioned before, emerged in 2009, and it's off its peak market capitalization, but it's still currently worth $367 billion. That's as of this morning. So that's pretty impressive to go from zero to $367 billion. We also have the technology introduced by Bitcoin, the use of blockchains being adapted to making gold transferable again in a more convenient way than the tradition of having gold in bank vaults or warehouse vaults where account balances can be transferred by the keeper of the vault. So Tether Gold created in 2014, so it's still pretty new, has a market cap of 421 million, so a tiny fraction of Bitcoin's value. Actually, the leader in this segment is Pax Gold, which is over $500 million, still small compared to Bitcoin, but growing. And these provide a low-cost way of holding transaction balances in gold and making them transferable to anybody who can accept an Ether token, because these are issued as Ether tokens. There are legal obstacles to the use of these monies, and there are certainly obstacles to the creation of banks that are based on digital gold. But I think both Bitcoin and digital gold are sort of plausible competitors as monetary standards. And so let's think about which of the two of them is better, and then how they stack up against fiat money. As between the two of them, we can look to the historical experience with gold standards and see that you get a slow and steady growth, well, not quite steady, you get a slow growth on average in the supply of gold. Hugh Rockoff finds that the stock of monetary gold grew at 2.9% a year over the long 19th century. But one of the remarkable things about the gold standard is that the rate at which the gold stock grew was variable. It varied from 1% a year to 5% a year, and it varied in response to the current purchasing power of gold. So if the gold stock hadn't been growing as fast as the economies that were on a gold standard were growing, so that the purchasing power of gold had an upward trend, a rising purchasing power of gold stimulates gold mining. It pays to dig a little deeper into the gold mine. It pays to prospect a little more to look for new sources of gold. And as a result of that, the gold standard responded to demand shocks, or the growth in demand and the countries switching from silver standards to gold standards. So in a way, such as to stabilize the purchasing power of gold. That is, when demand grew, it satisfied that demand by increasing the quantity, rather than putting the burden of adjustment on the purchasing power of gold, the relative price of gold. So you can visualize gold having a flat, long-run stock supply curve, which means that over long periods, and you can see this in the historical data, it keeps returning to a pretty stable trend, a very flat trend in purchasing power. So the purchasing power of the US dollar was about the same, less than 1% different between joining the gold standard in 1879 and the classical gold standard being abandoned in 1914. Now, there is the problem of supply shocks, that is, unexpected new discoveries of sources of gold, the largest of which was the California discovery, but they were actually relatively small. The impact of the California discovery on the value of gold was smaller than you might think. The inflation in the price level it created was less than 1.5% for about a dozen years. But as I said, over the long period, purchasing power of gold was very flat. Now, in a Bitcoin standard, if we imagine a world in which Bitcoin is the predominant medium of exchange, so people are holding Bitcoin as a transaction medium, it would have a more stable demand than it has now when it's a speculative asset. but it would not respond well to shocks in demand or to growth, secular growth in demand, because the quantity of Bitcoin is absolutely inelastic. It grows at a programmed rate without regard to the value of Bitcoin, without regard to its price in dollars or its purchasing power over goods and services. So when there's variation in demand, the price of Bitcoin bears the entire impact of the demand shifts. And so the value of Bitcoin is quite volatile, as has been mentioned. There's no reversion to a steady secular path the way there was with the gold standard. And this purchasing power volatility is built into the design of the Bitcoin system. So Bitcoin has been successful at attracting investors, not so successful at attracting people who want to use it as a medium of exchange, for the reason that its value is quite volatile. And here's an illustration of that. So the red spikes are Bitcoin's average daily price change. This is for 2018 to 2019, but you can look at longer time series and see the same thing. The volatility of Bitcoin has not really changed over its lifetime. And it's because the supply curve is absolutely vertical. So demand shifts are reflected only in the price and not in the quantity. All right, so where does that leave us? Well, gold standards and Bitcoin standards are not going to establish themselves without a breakdown in fiat standards. People are going to continue to use fiat standards as long as they work tolerably well. Now, 10% inflation is on the verge of not working tolerably well. If we look at when countries with bad money, with high inflation rates, switch over to using the US dollar or the euro, if we look at when we see spontaneous dollarization, say in Latin America, it's somewhere between 10% inflation and 20% inflation. So if we don't bring down inflation in the dollar, we will see more switching away from dollars as an alternative medium of exchange in countries with weak currency, unless, of course, the euro has the same problem and the British pound has the same problem, and all the plausible candidate fiat monies have the same problem. But until then, established standards have this network advantage that people want to be paid in what they can turn around and spend today. And there's not much you can buy in goods and services with Bitcoin, nor with gold today. There are some outlying cases. If you look at Venezuela during its hyperinflation a couple of years ago, people were using Bitcoin as a medium of payment, and people were using gold as a medium of payment. In the gold mining regions of Venezuela, people were using flakes of gold in grocery stores, and prices were posted in grams of gold. But that's a pretty extreme case. The US dollar's been the first alternative in countries with weak pesos. So to get a spontaneous global switch to a gold or a Bitcoin standard, I think we'll have to wait for chronically high inflation in all the major fiat currencies, which of course is not something to hope for. But it's good to have something on standby, and it's good to give people as much access to that alternative as we can. So if we see a market switch, would it be to gold or would it be to Bitcoin? Gold has a larger installed base of users. There's about $11 trillion of gold above ground. Now, most of that is jewelry. The part of it that's in monetary form, that is bullion and coins, is something like 4 trillion. And that's a lot more than the market value of Bitcoin, which has been currently less than $500 billion. And gold's purchasing power is less volatile, as the last chart showed. But Bitcoin has another advantage, which is that because it's intangible and can be transferred peer-to-peer without custodians, it's harder for governments to suppress or restrict or shut down than a system of gold-based payments. So we have to see which advantage will prove more popular. But clearly, the more restrictive governments are, the more that favors Bitcoin over gold. But there are other alternatives. So there could be something like Hayek imagined. And nowadays, it would probably take the form of a stable coin indexed to a price index. That hasn't been tried. It's not clear it's viable. but who knows? Another alternative, and disclaimer, this is the goal of a project I'm working with some people on. You could have a crypto coin that has a more demand responsive supply in the fashion that the gold standard has, only responds more quickly in a matter of months rather than years. So what we want is to have better monies from the point of view of the users of money, and that means stable purchasing power. We need to allow free entry of alternative monetary standards so that we don't truncate the competition, so we don't prevent the discovery of better ways to serve money users. We want a level playing field and an open playing field. But as long as fiat money lasts, we'll need to continue to work on ways to impose rules on it, to constitutionally constrain it, to put it in that language. And a few years ago, I co-edited this book, Renewing the Search for a Monetary Constitution, that was published by the Cato Institute, so I'm obliged to plug it here. So thanks for your attention, and I'll hope for some questions.
Thank you, Dr. White. We have some great audience questions, and I'm going to throw this first one out to anybody who wants to answer it. I love this question. It's my favorite category as a journalist. It's the, explain it to me like I'm a precocious 12-year-old type question. It's the first one that leaps to mind anytime somebody talks about digital yuan or a dollar stablecoin. Bill asks, Professor Prasad said that central banks need to go digital to stay relevant. Isn't the dollar already digital? I never use paper dollars anymore, right? We're moving dollars around as database entries. Now we're going to move them around as database entries on a blockchain. It's a centralized blockchain. What's the difference?
Well, I guess any of us could answer that. It's the distinction is between commercial bank money and central bank money, right? Your account that you're looking at on your phone or whatever, that's commercial bank money, and it's almost the same, not quite, which is why in a panic people might substitute from one to the other, and it settles differently. But right, so it's digital. It's for almost any purposes that you might as a retail person put it to. It's a dollar, but it isn't quite a dollar. And I don't know if that's what the precocious 12-year-old wants to hear, or if one of my distinguished colleagues wants to add to that.
Sure.
I see a hand, Dr. White.
Yeah, you're absolutely right. We have digital dollars now. The wholesale payment system is digital dollars. Banks have accounts on the books of the Federal Reserve System, and they transfer lots of dollars every day through that means. And we also have retail digital dollars, but those are provided by private institutions. So Venmo are privately issued digital dollars that serve, although its construction is not quite that of a peer-to-peer currency, it serves just like that. And of course, WeChat Pay and Alipay are digital quasi currency systems. But I think Professor Green was right that there's a kind of fear of missing out by central banks from the retail side. So the proposals for a central bank digital currency are proposals for the central bank to expand from just providing wholesale digital payments on its books to providing retail payments on its books. Most of the proposals are not for a blockchain-based system, but for people to have accounts on the books of the Federal Reserve System. And there's absolutely no rationale for that survives the critique we heard already.
Yeah, I think
Dr. Reed, do you agree?
Yeah, so well, I'm not quite that skeptical, but I do think there are some benefits. I just think there's a bunch of risks too, and it all comes down to design. And actually, the optimally designed central bank digital currency for the US is going to be different from the optimally designed central bank digital currency for Europe, which will be, it will be different in every single jurisdiction because we're all trying to address different challenges in different ways. I will say one difference, because it was mentioned $1 at your commercial bank and $1 at the central bank is very close, but not exactly the same. The theory is that the motivation's a little bit different too. So a central bank as a public institution has more interest in kind of the public good and addressing some of these big societal issues, whereas a bank really just wants to maximize their profits, or Venmo just wants to maximize their profits. So I guess in theory, at least, the motivation behind it might be a little bit different.
Now a question totally distinct from that one about energy use. This is something that I wonder as well. Bobby asks, regarding the White House energy report, should the government really be choosing proof of stake over proof of work? Or more broadly, should the government be picking any winners? And just to distinguish for those who are not as deep in the weeds as I am, of course, proof of work is the very energy intensive way that Bitcoin currently works. Proof of stake is what Ethereum is trying to move toward, that is much less energy intensive. So anyone who wants to take that, it sounds like Dr. Musto, you're pretty deep in these weeds.
Yeah, so proof of work, right? That's where it costs something like $6,000 worth of electricity to mine a Bitcoin. And so that's a lot, right? And so what I was saying was that when you hear industry people talk about it, say, well, okay, yeah, right, that's all true. But we have tried hard to locate where we're taking off excess energy. And so it's not like we are taxing anyone else's energy use. That's, one thing that the White House pointed out is that the amount of mining going on in the US has recently gone up quite a lot. So that I think there's statistics where it was like 0.3%. It was very low just a few years ago, and now it's like 38%, right? So it's maybe hard to keep up exactly whose grid is funding all that, is supplying the electricity for that mining. Well, so, I mean, I guess the Biden administration would say, well, okay, no, we are going to pick a winner here, or we'd like to, because we don't want energy use that way. And that's our job in public policy, to push back on that. All right. I mean, I guess that's what they're saying. I didn't read the whole report. I know I was too much going on this morning, but I know I could cross my radar, and I glanced at a summary of it.
Go ahead, Dr. Wade. It looks like you have some comments.
I would say it's absolutely not the role of public policy to say how we should use our electricity. If you're willing to pay the price of electricity, and if you're willing to pay enough to compensate any technological externalities from the use of electricity, then you should be free to use your electricity as you like for any lawful purpose. So we don't say people can't fly because jet fuel contributes too much to global warming. We don't restrict other activities that use a lot of electricity. And so the government shouldn't be in the job of judging which uses are worthy and which are not worthy. If people are willing to pay, the users of Bitcoin bear the costs of the electricity used to keep the Bitcoin system running. And if they're willing to bear those costs, more power to them.
So we have another question that I want to jump to because I think it's a really critical one. I mean, it's a variant on the answers that all of you gave to the first audience question, but I think there's an important distinction here. So Roger asks, what benefit does a central bank digital currency offer that is not already offered or soon to be offered in the private and public sectors? I feel like it's a nice way to slice some of the skepticism that all of you have expressed. You know, CBDCs are coming about, it sounds like, because of FOMO. But, you know, when we're designing them, you know, when we're thinking about, are we being pushed into them versus is this deliberate? Does this really get us something that we're not going to get soon from the private sector? So anyone who would love to address, who would like to address that.
Well, I think Megan listed a lot of them. I'll go ahead and, yeah.
Yeah, I mean, I would just support that point. You know, with the Swiss Army knife example, right? A Swiss Army knife does a lot of different things, but it doesn't do any of them as well as another tool might. And so I do think there are a bunch of solutions that are coming out of the private sector that may or may not be here yet. For example, financial inclusion, India is a great example, right? They figured out how to give everyone a bank account for free. It just needed to be subsidized. They didn't need to create a central bank digital currency for it. And it reduced the number of unbanked Indians significantly. It's just one example, but I do think that there's a single tool for each one of the goals for central bank digital currencies that I mentioned that does it better. But the benefit of a central bank digital currency is it makes some progress on all these things at once.
I think if we look at it from the point of view of consumers and ask what payment options and features are they willing to pay for, the private sector will try to find those and try to make a living providing them. So it would be surprising to me if there were any benefits that haven't already been provided.
I suppose in times of severe stress, a central bank digital currency is safer than money from your bank, and so that is a benefit.
Even when the bank deposit is insured.
No, if you have unlimited, deposit insurance, that's fine, but you don't anywhere really. So, and no one's talking about it. So up to a certain amount, fine, your deposits are safe. I can give you Cyprus as an example of that not even being a sure thing, right? When they were talking about having haircuts on deposits that should have been safe. So you do know with absolute certainty that if you got an account with the central bank, they're not going to give you a haircut on those deposits. That's one benefit nobody else can give you with quite as much security.
Well, treasury bills provide that kind of security.
Some might argue they don't. Some might argue that U.S. debt is so high it's unsustainable. I wouldn't argue that, but it is an argument.
Well, they're not going to default in the technical sense. They're always going to be able to print the dollars to pay you back what you're owed. The question is, what are those dollars going to be worth? And that's a question for central bank digital currency just as much as it is for the dollars we have today.
So I'm going to interrupt here because I'm sensing something that comes up in my reporting a lot, which is an irreconcilable economist debate. And we have time for one more question. This one Phil asked on the event page. He directed it to David, but I'd love to hear this from any of you. What are your students most interested in? Is it cryptocurrency, different fintech business models, or something else?
Well, so I see the whole range of fintech enthusiasts, and people are picking off different part of the whole space. It could be we interact with startups involved in securing transactions, in dealing with KYC, AML issues, with just so many things. We have almost no time left here. So let me just summarize by saying, looking all around the possible solutions for a distributed ledger with one or another kind of verification technology, and trying to figure out how they're going to start their own company before they leave college. That seems to be the big difference when I went to school. Now they all want they all want to start their own firm, and some of them are, right. Well, we'll see how well they do.
And I'd love to hear from the rest of you as well, what your students are interested in, or any other folks you're working with.
I'm teaching a course this semester, which is a PhD course in monetary theory. So there's interest in cryptocurrency, absolutely, but also in central bank digital currencies, in the gold standard, in alternative monetary arrangements of various kinds. They're not planning to start businesses, but they're looking for research topics.
I teach a seminar series on central bank digital currency and monetary policy tools. So I would say that, but that's because I'm talking my own book. It's biased. I would say students generally are interested in cryptocurrencies, stable coins, and CBDCs, but there's very little connection that I hear about between the two of them. So either they seem to be really interested in private sector digital currencies or central bank digital currencies, but there's a big gap, it seems like, between them.
So we are right on time here, and I want to keep things moving. So Lawrence White, Megan Green, David Musto, and Dr. Prasad, who had to leave early, thank you very much for being a part of this fascinating and deep panel. And thank you to all the viewers who tuned in. I hope you got as much out of this as I did. And I'd like to turn it over now to Jim Dorn, Vice President for Monetary Studies at the Cato Institute.
Thank you. And thanks again for chairing that session, Christopher. Appreciate it. I'd like to thank the speakers and the chairs today. They did a great job, as well as the Cato staff and my friend Norbert Michel, who is the director of the Center for Monetary and Financial Alternatives at Cato, for his support throughout this whole process. And especially Jay Bowen and his family foundation, who helped finance this particular event. We began today with a general discussion of Fed policy with Jay Powell and Peter Gettler, and ended with the future of money. What I like about the 40 years of running this conference is the fact that our speakers present various viewpoints. We encourage a civil discussion of key policy issues and alternative monetary regimes, thus fostering the free market and ideas. The hope is, of course, to improve the monetary regime by reducing, to the extent possible, uncertainty about the course of monetary policy, and by examining the evolution of monetary and financial systems. These are goals also, of course, that Chairman Powell supported earlier in the program. Cato has published numerous works on monetary policy and monetary history, and I encourage you to visit our website to explore some of our research. I hope you can all join us for future events. Thanks for listening in today and for your patience in dealing with some of the technical issues. We'll be airing Larry Summers' remarks as soon as the audio is fixed, which I imagine would be fairly soon. On a personal note, this is my final conference, so I'd like to thank all those who have made it possible to reach number 40. And I've bypassed that age by a couple decades, so that's a good thing too. Anyway, enjoy your weekend, and thanks very much for joining us today.